Good afternoon and welcome to the 4th edition of the BIS Innovation Hub. My name is Codruța Boar. I'm an advisor at the BIS Innovation Hub, and I have the privilege of being the master of ceremonies for this event, or in other words, the voice of a much bigger team who worked to make this conference happen. It is a great pleasure to see so many people here with us in person and to be connected to so many of you joining virtually from around the world. Thank you for joining. This year's summit is about navigating rapid innovation. The bad news is that I don't have a map to help you navigate this. The good news is that we have put together an exciting program which can help shed light on directions to take. So I would say, let's start. For this, I have the pleasure of inviting the BIS General Manager, Mr. Agustin Carstens, for opening remarks.
Well, good afternoon. It's really a privilege and an honor and I think very invigorating to see this room full, having some very distinguished guests as Joaquin Nagel and other very important people in the industry. This is the 4th BIS Innovation Summit, and I'm very pleased to see that it has kept its dynamism from the beginning. So the summit demonstrates year after year, has demonstrated year after year, the need to discuss the power of technology and innovation. The theme of this year's summit, Navigating Rapid Innovation, could not be timelier. Facts speak for themselves. Netflix needed 3.5 years to reach 1 million subscribers. Spotify reached that number in 5 months. ChatGPT in 5 days. Threads needed only 1 hour. All these innovative digital platforms created opportunities that didn't exist before. When the first smartphones appeared, nobody could have predicted the million of apps that exist today. The platform had to exist first. Smartwatches, wireless headsets, and streaming video from a phone into a TV would not exist today without the Bluetooth technology that was developed in the mid-90s. However, the acceleration of adoption that I just mentioned changes the impact that innovation has on societies, sometimes in unpredictable ways. Sometimes it is for good. Today we see glimpses of this level of technological change in the financial system. In many countries, cash use is dwindling. Fast payment systems allow transactions to settle instantly and on a 24/7 basis. In some emerging market and developing economies, digital identity systems have made it easier and cheaper for people to open bank accounts and access the financial system. When the COVID-19 pandemic hit us all 4 years ago, some small developing countries in Africa were able to send e-money directly to people's mobiles, while some very large advanced countries were struggling to put millions of checks in the mail. Yet the picture is incomplete, and sometimes the impact is more complicated to evaluate. In many countries, even developed ones, too many people remain unbanked, and even in the most technologically advanced societies, many financial transactions still take days to complete and rely on time-consuming clearing, messaging, and settlement systems, especially across national borders. Various technological solutions have appeared in the financial system, but many of them still exist in silos. In too many respects, today's financial system is still serving the past, not the future. This is a missed opportunity and one that not only has monetary but also human costs. Central banks have a duty to support the development of a financial system fit for the future. The question is how. In my view, there are two distinct but complementary approaches: small steps and giant leaps. By small steps, I mean tweaks and improvements to existing financial systems and infrastructures. This approach has its place. It can deliver quick wins, timely improvements in the quality and efficiency of financial services that come at relatively little cost. It is comparatively low risk, an important consideration when dealing with critical infrastructure. And it can help allay concerns that financial innovation could disadvantage smaller financial institutions and less technologically sophisticated consumers. But incremental change also has its limitations. The need to look backwards to ensure compatibility with legacy systems constrains what new ones can deliver. As the layers build, the constraints become more binding, eventually holding back innovative developments. This is why I believe that sometimes we need giant leaps that deliver a fundamental rethink of the financial system and foster the development of entirely new architectures. Let me give you a concrete example of a giant leap. Tokenization is, in my view, a technology with transformative potential for the financial system. Tokenized digital assets contain both the information necessary to uniquely identify assets and their owners, as well as the rules and logic governing their use. When correctly used, tokens could increase the speed, lower the cost, and heighten the efficiency of financial transactions. Note my qualifier, correctly used. It is important. By themselves, tokenized assets could improve the financial system only incrementally. If tokens were to trade through existing financial pipes, they would have to rely on the same long and complex sequences of messages passed back and forth between financial institutions. And these complex sentences are the cause of many costs and delays in today's financial system. To unleash the promise of tokenization, i.e. to deliver a giant leap, we need to bring the different kinds of tokens together: commercial bank money, central bank money, tokens on different assets. Unified ledgers are the platforms where this can happen. Once these different tokens are brought together in the same programmable platforms, new functionalities can be deployed, like smart contracts and composability. With them, sequences of transactions could be automated and seamlessly integrated. This would eliminate the need for manual interventions and redundant compliance controls, two issues that significantly delay transactions along the chain of a cross-border payment. It would also enable simultaneous instant payments and immediate and simultaneous settlement across a whole range of assets. Tokens could, in principle, contain any financial asset, but tokenized money is a core requirement. As Yuval Noah Harari, whom you will have the pleasure to listen to in this conference, said, "Money is the most universal and most efficient system of mutual trust ever devised." The unified ledger system would build on the trust of the two-tier system of today's financial system. All transactions are carried in commercial bank money, but their final settlement happens in central bank money. And even greater leaps are possible. In a recent paper, Nandan Nilekani and I laid out a vision of how multiple financial ecosystems can interact with each other to form the future financial system. which we have labeled Finternet. The Finternet would empower individuals and businesses by placing them at the center of their financial lives. Unified ledgers connected to each other through application programming interfaces play a central role in this vision. They would be accompanied by a rich canopy of associated financial applications and services, delivering more choice and lower costs to users. Technology is critical, but not sufficient. It is only effective once it finds its economic and financial purpose and is underpinned by robust regulatory structures. To create a truly coherent vision of the future financial system, we will have to supplement cutting-edge technologies with an efficient economic and financial architecture and robust governance and regulatory arrangements. I would dare to say that we are more advanced in the technology than in the other key aspects, legal, regulatory, and operational, that are needed to make it work. So then, how do we achieve giant leaps? How do we transform a vision into reality? The first step in this long journey are exploring and experimenting. But in doing so, we should always have in mind the larger purpose, the giant leap we hope to achieve. This is exactly what we do here at the BIS Innovation Hub. As an example, let me describe our efforts to explore the potential for unified ledgers with Project Agora. This ambitious new project explores how the tokenization of wholesale central bank money and commercial bank deposits on programmable platforms could improve the monetary system. A first use case is to push the boundaries of cross-border payments. Agora was designed to be global and inclusive. It brings together major international currencies, the dollar, euro, yen, sterling, Swiss franc, Korean won, and Mexican peso. The central banks that issue these currencies are some of the most advanced in the world in terms of their technical capabilities. Moreover, the regulated private financial sector institutions that will soon be invited to join Agora will hail from these jurisdictions that sit at the core of the global trading and financial system. Agora illustrates how the BIS Innovation Hub is fulfilling its mandate to examine the potential for technology to build the financial system of tomorrow and to add practical applications to the careful theoretical and conceptual work that has started at the BIS with conceiving the vision of unified ledgers. As you can see, we have great hopes for this project and the leap it can deliver, and look forward to working with official and private sector partners around the world. When we look at this year's Innovation Summit, the two approaches that I mentioned, the small steps that improve what we have and the giant leaps that concrete something new, are clearly embedded in the agenda. Over the next 2 days, you will have the chance to discuss in greater depth the elements of unified ledgers and the building blocks needed to enhance existing infrastructure. You will also hear more about Mandala, mBridge, Brixtal, Nexus, and other very exciting BIS Innovation Hub projects. Another technological innovation, artificial intelligence, features prominently in the agenda and poses very difficult questions for us. I started my remarks talking about the acceleration of innovation. Today, advances in AI are measured in months, sometimes in weeks. So, which of the approaches I suggested should we use to adopt AI tools? Incremental changes or quantum leaps? I don't know the answer and hope you will help me find out. In any case, a key message that I would like you to take away from the summit is that the real magic of innovation is to open up possibilities that were not there before. I wish you the very best for the summit and look forward to debating these issues with all of you going forward. Thank you very much for your attention.
Thank you, Mr. Carstens, for the not only opening, but I would say eye-opening remarks. We will continue now with the keynote speech of this day. For this, let me welcome the Governor of Banque de France and Chair of the BIS Board of Directors, Mr. François Villeroy de Gallo.
Thank you very much. I hope you can hear me. Dear Agustin, dear colleagues and friends, I would have preferred to be physically with you, but it's still a great pleasure to speak at this Innovation Summit, especially to tackle a dilemma that all of us have to face. Should we adopt new technological innovations now or wait for them to mature further? None of us obviously has a crystal ball. We cannot know for sure which innovations will flourish or when, nor what impact they will have on the economy and financial sector. Let me give a famous example. The electric car was first invented in the 19th century. We should not forget that. Only to be overtaken by gasoline cars, but these days, the electric vehicle is back in the spotlight again. Of course, as central banks, we are not innovating for innovation's sake. And innovation has a cost. The closer an innovation stands to the current technological frontier, the higher its cost. However, as central banks, we must definitely keep up with developments if we are to remain benchmark players. And this will be my first point. In addition to the question of when is the right time, this raises a more specific challenge for us: how to overcome the apparent contradiction, oxymoron, between innovation and stability. I will, in a second point, focus on a new high priority area, artificial intelligence, already alluded to by Agustin. So, about the oxymoron. Central banks and supervisors are directly interested in innovation. And it's not only to keep pace with their private partners, but also to channel innovation, including private innovation, towards the common good. Taking advantage of new technologies involves 3A, active monitoring to identify worthwhile innovation, analysis to detect the potential risk and vulnerabilities, and yes, anticipation of future threats. Let me take the example of quantum computing. The technology may not be mature yet, but we have to prepare now for the consequences it will have on cryptographic methods. This is why last June, the Banque de France launched and successfully conducted an experiment with a private partner to develop post-quantum algorithms. Coming back to the oxymoron, innovation means movement, change, and ultimately a certain degree of risk-taking. Central bank's mission, on the other side, is about monetary and financial stability. Winston Churchill once said, "Without tradition, art is a flock of sheep without a shepherd. But without innovation, art is a corpse." This is admittedly a strong way of putting it, but I believe there is a large part of truth in this. Innovation without stability will lack trust, and stability without innovation would result in stasis. And historically, central banks have not been only followers or adopters, but themselves innovators. For the greater public good, think of the Eurosystem infrastructures in payment. Let me focus on money. Money, which is our core business and which is and will remain a public-private partnership that has to evolve. The way we make central bank money available has to be geared to the 21st century to ensure that central banks maintains its fundamental role. And let me stress that this role is not to be the dominant means of payment, but to be a stability anchor for the financial system. This is why I believe that sooner or later we will need a CBDC, central bank digital currency, for wholesale as well as for retail purposes. As you know, we are preparing accordingly at the ECB and the Banque de France, and commercial banks need not to be fearful. But let me broaden the view about the future of payments and follow what Agustin said some minutes ago. The landscape of payments is evolving rapidly with numerous new elements. Let me take an image. Some of these elements are solid, almost set in stone, like the G20 objectives on improving cross-border payments or regulating cryptos. Other elements are more liquid, albeit very promising. We don't know completely yet the interconnection of successful fast payment systems like UPI in India, PIX in Brazil, and possibly TIPS in Europe. The tokenization of assets. And let me insist there that European banks shouldn't lag behind in the domain of tokenizing deposits. And yes, a third possible liquid element, CBDC. One could even argue, to follow my image, that there are still very important but gaseous elements, such as AR, which I will come back to. What we need now is not to choose among these various elements or technologies such or such, but to articulate these elements as part of a global picture or vision. We must at once follow innovation with humility and openness, but also, I believe, lead innovation and reflect on it in a holistic manner. Here, the idea of a unified ledger proposed in the latest BIS annual report and just developed by Agustin may prove more than just a promising technology, a rallying concept. Accordingly, the BIS recently launched Agora, and the Banque de France is very happy to represent there the Eurosystem with other central banks and a large group of private financial firms. A necessary step towards such a global infrastructure could be to build regional unified ledgers, one of which would be European. Let me now turn to my second point about artificial intelligence. It has gained widespread public attention thanks to exponential leaps. These are not small steps, obviously, over the last few years, especially generative AI. For sure, let us be honest, there is still more talk than walk, and the AI hype could be followed by some disappointment. But that said, AI is a typical example of an innovation where central banks would be mistaken to wait until they have gained absolute certainty. And absolute certainty we have not today. Earlier this year, the IMF ventured a preliminary estimate, almost 40% of jobs around the world and up to 60% in developed economies may be affected, with AI acting either as a substitute to or as a complement to labor. However, according to a recent report coordinated in France by Philippe Aghion, only 5% of jobs are at risk of being fully replaced. This distinction between substitute or complement is also stressed in a IMF paper co-authored by Daron Acemoglu. One of our key challenges is to make sure that the human AI complements humans instead of replacing them. The pioneering European AI Act is designed specifically to foster trustworthy AI. And we should be careful not to repeat the mistakes of the past. One of them would be that an excessive concentration of AI players would be detrimental on many levels. This danger may increase further if too few AI models lead to a loss in information diversity and to misalignment between human cognition and AI algorithms. Here again, for central banks, learning by doing is of the essence. Today, we at the Banque de France have already deployed AI in several prototypes and different areas. We will step up this activity this year with the support of our innovation lab and scale up our use of AI. May I perhaps focus to end with on some principles, 3 principles of a doctrine that we are reflecting on and which can hopefully also serve our central banks. 3 imperatives. First, understand and master. We need to ensure that we thoroughly understand the models and their outputs in order to maintain full control over activities, avoid the black box syndrome. Having state-of-the-art domestic AI platforms available on the market would be very beneficial in this regard, given the sensitivity of some of the data we handle. Therefore, it's quite high on my wish list. In Europe, we have the expertise and resources needed to compete with the major current incumbents, as recently stressed by Christine Lagarde. This would benefit all countries around the world. The more AI providers we have, the less risky our use of that AI will be. Diversification is an effective risk management tool. Second principle, buy-in. In line with the idea that AI should complement human labor and expertise, gradualism is also needed in the way we integrate AI. This will help to ensure employee buy-in. And this challenge should not be underestimated. It might be the most difficult. We have to find the right kind of human-machine interaction. In practice, this means training, feedback, and continuous improvement, all good reasons to tackle the learning curve as early as possible. Last but not least, third, cooperate. We need to move ahead together by enhancing cooperation, and not only among ourselves, between central banks and financial supervisors, but with other authorities as well, both domestically and across borders in different fields. Let me quote some domains: competition, cyber resilience, fundamental and personal rights, climate transition. Can I share a personal conviction? If Keynes and the other founding fathers of the post-war international order were to start over today, 2024 in Basel, they would probably, according to me, create a WDO, World Digital Organization, to cooperate, to stimulate, and to regulate. In the absence of such a WDO, we will need to be creative. This brings me to my conclusion. To answer today's question in an even more straightforward way, yes, central banks must rapidly start adopting new technological innovations, including AI, in a rational, clear-headed, and controlled way. And as we speak about innovation, let me quote an ancient philosopher of the Roman Empire, because this is not a completely new story. Seneca rightly said, "It's not because things are difficult that we dare not venture. It's because we dare not venture that they are difficult." I wish you the best possible summit and thank you for your attention.
Thank you, Governor, for these insightful remarks. In the next session, we will dive deeper into new technological innovations, and we will look at the future of CBDCs. For this, we have a high-level panel discussion with key central bank governors who are joining us both in person and virtually. Let me welcome on stage the BIS Economic Advisor and Head of Research, Mr. Hyung Song Shin, to moderate the conversation.
Well, thank you, Kodruta, and thank you to Augustin and Francois for opening this event. My name is Hyun Song Shin. I'm the economic advisor here at the BIS, and it's really my pleasure to moderate this first panel. I think Francois laid out the apparent sort of tension very well between central banks, who are very much the guardian of stability on the one hand, versus innovation on the other. But in a way, central banks really have to be at the center of much of the innovation, because central banks issue the unit of account and is ultimately there as the guardian of the trust in money. And all the economic activity that we see ultimately builds on that. And in that regard, it's really my pleasure to have this conversation with three governors that are really at the forefront of the innovation activities around central bank money. And I put it like that, rather than CBDCs as such, because the themes are really very timeless. They go beyond some of the sort of more narrowly posed questions surrounding CBDCs. So what I'd like to do, and so let me introduce the panel, and let me go in alphabetical order. So online we have Governor Shaktikanta Das, who is the governor of the Reserve Bank of India. And as you know, India has really been at the forefront of digital innovation, especially with regard to their digital public infrastructure. And the RBI has also been very much involved in the piloting of CBDC experiments, both for retail and for wholesale CBDCs. Joining me here on the stage is Joachim Nagel, the president of the Deutsche Bundesbank. I mean, not only is he a very familiar friend, and of course, he's leading one of the most important central banks, but we're particularly happy to have Joachim here because he's leading a very ambitious transformation agenda at the Bundesbank, Wandel, as it's called. And I think there are some very, very important lessons that we can draw from there. And online, we have Governor Fabio Panetta of the Bank of Italy. He's also, Fabio is also chair of the BIS Committee on Payments and Market Infrastructures, and in that respect has really an unparalleled vantage point on central bank activities on digital innovation, especially in the payments arena. As Augustin mentioned, this is not simply a matter of digitizing central bank money, either for use by individuals or as the main settlement medium that preserves finality. But it's the fact that this property of central bank money as being the ultimate settlement asset is also underpinning a lot of the important innovations that are happening where we are combining the digital information in the underlying commercial bank money or central bank money, but also putting them on a programmable platform and thereby combining the digital information with the rules and logic that govern the use and govern the transfers. And this is what's ultimately underpinning tokenization. Agustin mentioned Project Agora, which is our latest project in this regard, and we have great hopes for this. But it's, I think, something that shows the potential for what can come in this direction, in this field. So what I would like to do, if I may, is to start with Fabio. And Fabio, as the chair of the CPMI, you have this really unparalleled sort of vantage point on all the experiments that are going on within central banks. And perhaps it would be a good way to start this conversation if you could give us some insights on what you see as being the key considerations for central banks in their development of both retail and wholesale versions of central bank digital currency.
Thank you, Yoon. Good afternoon, everybody. And first of all, let me thank you for and the BIS for the invitation to join this conference today. It is a great pleasure to participate in the BIS Innovation Summit and to discuss these very timely, relevant issues. You're right. As chair of the CPMI, I have the benefit of a broad perspective. Across the CPMI memberships, but also for jurisdictions beyond the CPMI, I have a chance to see the CBDC journey unfolding in different ways in different jurisdictions. Since 2017, the CPMI Secretariat has been collecting information from central banks to understand the current state of CBDC work, central bank modulations, and also the likelihood of issuance of CBDCs. The 2023 results have not been published yet, but of course, I can break the rule and share with you three key observations. First, more than 90% of, almost all, 90% of central banks are exploring a CBDC. The work is progressing to more advanced stages. More than half of the central banks are conducting concrete experiments or working on a pilot. Second, the motivations and drivers differ between retail and wholesale CBDC. It is important to distinguish between these two categories because they clearly serve two very different purposes. Just as banknotes and coins are very different from reserves held at central banks. Wholesale CBDC is about innovating the activity of intermediaries on wholesale markets, while retail CBDC is simply about the provision of a digital form of cash that would allow consumers to use central bank money in a digital format. Now, central bank money is only physical, paper banknotes. The CBDC survey shows that central banks are increasing their attention to wholesale CBDCs. We see a sharp increase in the number of wholesale experiments. Moreover, the likelihood of central banks for central banks to issue a CBDC within the next, let's say, 6 years is now higher for wholesale than for retail CBDC. And third, there are significant differences across countries. Each jurisdiction is unique in terms of its local conditions, the features of other payment systems, and its policy objectives. This influences the motivations of central banks in exploring a CBDC. Some central banks see CBDCs as a tool to safeguard the role of central bank money as the anchor of the monetary system, both in the retail and the wholesale level. For example, some central banks are considering a retail CBDC in order to ensure public access to central bank money amid the rapid digitalization of retail payments and the decline of cash. Other central banks are exploring retail CBDCs mainly to promote digital financial inclusion and to improve payment efficiency while ensuring cybersecurity and the right to privacy. For example, by ensuring universal access and by embedding new features such as offline payments. In the wholesale context, various central banks are exploring wholesale CBDC as a settlement asset for tokenized wholesale transactions. For other central banks, instead, CBDCs can be a way to bridge the traditional financial sector with the decentralized finance environment and to offer an opportunity for innovation that goes beyond payments. Also, some of the retail CBDC work is partly motivated by the increasing popularity and risks of digital private money, such as crypto assets. So overall, the ultimate goal for a central bank issuing a CBDC is to provide additional opportunities for intermediaries to meet the demand of people and market participants for financial services that are efficient, safe, and affordable. Let me be clear on this. Central banks need to identify what the essential design features of a retail CBDC should be in order to be an efficient payment instrument, and which elements of existing solutions should be reused in order to avoid unintended effects of on the payment market. But in order to do so, they should engage with a wide range of stakeholders, from legislators to retail payments ecosystems and the broader public. In this regard, the evidence collected in the context of the Eurosystem Digital Euro project seems to point to a common vision that a retail CBDC should be issued by a central bank and distributed by supervised intermediaries to their clients, as it is currently the case for cash. Cash is used by central banks but is distributed by commercial banks. Let me conclude by emphasizing that CBDCs could also improve cross-border payments. How? Well, by increasing the speed and transparency, facilitating access and reducing costs. But of course, it must be clear that ultimately the decision on CBDCs is a sovereign one. It's a decision by governments. This underlines the importance of cooperation among jurisdictions. Some jurisdictions may introduce a CBDC, while others may not. And for this reason, some are moving faster than others, and there is a risk of fragmentation, which would hamper cross-border payments. So in order to offer users a seamless payment experience, both domestically and internationally, we should ensure that CBDCs are interoperable with existing payment systems, but also with other CBDCs. Cross-border CBDC is part of the work program of the Committee on Payments and Market Infrastructure for 2024. Yoon just mentioned that I chair the committee. The committee is currently working to identify how central banks can effectively cooperate on cross-border CBDC functionalities. Initiatives between central banks and the BIS Innovation Hub, and in particular, discussions as today's conference are therefore very valuable. Thank you, Yun.
Thank you very much, Fabio, for that really great overview. So I guess one message that Fabio has just laid out is that since 2017, when the CPMI started the survey, there's certainly been a great deal of interest among central banks in pushing the digital agenda. But there's been a shift in the last year where there's been a shift in the center of gravity, if you like, somewhat more towards wholesale applications, which I think is also laying out very clearly that the customer-facing activities will have to be borne to a large extent also by the private sector. And so it's this two-tier system that Agustin mentioned in his opening remarks that are really going to really be a key element of this. On the cross-border element, perhaps we can come back to this, but first let me turn to Governor Das. Shaktikanta, in my opening remarks, I alluded to the fact that India has really been at the frontier of digital public infrastructure. We all know about the Unified Payments Interface, or UPI, which is held up often as a great success story. But the RBI has also been at the forefront of various experiments and initial work on both retail and wholesale CBDCs. It would be great if you could share with us on the current state of play and the lessons that you have learned so far.
Thank you very much for inviting and giving me this opportunity to share some of my thoughts. Now, I sincerely believe that CBDC, with its unique technology, has a transformative potential. In response to the specific question that you have put, I would like to highlight the Reserve Bank's motivations and experience in running the CBDC pilots, both in retail and in wholesale mode, their design principles, and our key learnings. I shall also touch upon the unique steps that we have taken and the future work in this space. UPI, as you have mentioned, is now witnessing about 13 billion transactions every month, 13 billion transactions every month. Now, despite this, very impressive progress, there is still considerable scope for increase in digitalization of payments. This can be facilitated through CBDC, which has the same advantages of cash, namely anonymity, ease of usage, and finality of settlement. Specifically in the context of cross-border payments, the feature of settlement finality can substantially reduce the cost of transactions. Further, CBDC can drive financial inclusion and provide much safer alternatives to private digital currencies, which are, according to us, potentially dangerous. In India, we have adopted a phased approach to CBDC implementation. The wholesale pilot was launched on November 1st, 2022, and the retail pilot was launched a month thereafter on 1st December 2022. The pilots have tested the entire process of digital rupee creation, distribution, and usage in real time. The wholesale pilot use account-based CBDCs and are currently focused on government securities transactions using a centralized ledger and overnight call money transactions between banks using distributed ledger. The basic objective of the wholesale pilot is to mimic the settlement efficiency of cash as it removes the need for central counterparties, settlement guarantee infrastructure, or the need for collateral. Wholesale CBDCs can help in better monitoring of transactions from a risk perspective by moving to what you call a delivery versus payment DVP1 method, wherein both the cash leg and the securities leg of a transaction are settled on gross basis, as against the present DVP3 mode where both legs of transaction are settled on a net basis. Now, going forward, other instruments like commercial papers, certificates of deposit will be tried out in the pilots, along with securities tokenization features. The retail pilot uses token-based CBDCs on a blockchain and enables both merchant payments, that is P2M, and person-to-person, that is P2P payments. The retail pilots are expected to create familiarity with the CBDC, which has features of both cash and digital instruments. We have leveraged the existing merchant infrastructure on the UPI to facilitate CBDC transactions. We have also enabled interoperability of CBDC with UPI. While the number of transactions have reached a high of 1 million a day, we still see preference for UPI among the retail users. We of course hope that this will change going forward. Now, going forward, the advantages of CBDCs will be more visible when we enable offline use and programmability features. Let me also mention that a key objective of the pilots has been to study the change in consumer behavior vis-a-vis bank deposits. We need many more transactions to understand its wider economic effects, especially on monetary policy and the banking system. I would now like to turn to some of the important design principles and key learnings from the pilot, and I would like to list them out. First, we have envisaged our CBDC as non-remunerative by making it non-interest bearing. This feature should mitigate any potential risk of bank disintermediation. Second, we have adopted a two-tier distribution architecture where the central bank creates the CBDCs and the banks distribute the CBDCs. Third, the digital rupee CBDC currently has fixed denominations similar to physical currency. This makes it easier for users to relate to CBDC as a digital form of cash. We are, of course, open to other design choices and will try them out in our future pilots. Fourth, anonymity can be addressed through legislation and or through technology. For example, through permanent deletion of transactions. That could be one method. The basic principle is that CBDC can have the same degree of anonymity as cash, no more and no less. Fifth, one of the key features of cash is that it works offline. We are working on making the CBDC transferable in the offline mode also. We are also introducing programmability features to promote financial inclusion and provide other value-added services under CBDCs. Sixth, the design and scalability of technology like permissioned blockchains for CBDCs, which we are using currently, require improvements to meet the challenges of population-wide adoption. Seventh, and finally, we have also recently announced the participation of non-banks in the pilot, with the expectation that their reach can be leveraged for distribution of CBDCs and for providing value-added services. To conclude, let me say that so far we have gained significant insights from the two pilots, wholesale and retail, on various aspects such as design, technology, and user behavior. These insights are facilitating scalability, resilience, and agility of the CBDC system. The pilots are also enabling us to make informed decisions like positioning the CBDC alongside the UPI. CBDC offers unique value proposition as a currency system, a store of value and anonymity while complementing the existing digital payment systems. I will stop here. Thank you very much.
Thank you very much for that overview. There are a couple of things that I think would really be interesting to follow up, especially the link between the retail CBDC and the existing payment system. I think this is a question that many central banks face, which is how much weight should be put on fast payment systems, how much on retail CBDCs. I think what you've described is that you're designing it from the ground up to make sure that these two systems are interoperable. But I would like to follow up on that in the second round. Joachim, it's great to have you here. Thank you for joining us. I'd like to tell you an anecdote, actually, before I ask my question to Joachim. Recently, we had the BIS Leadership Forum, which is a forum for the managers, everyone from the middle management up, and it's a way to sort of renew our purpose. And we invited Joachim to give the keynote speech, and he gave a very, very inspiring keynote speech where he described the transformation process that he's leading at the Bundesbank, Wandel, as it's called. And Joachim, you said that innovation is a key part of this process. You compared this whole process to running a marathon, where you need the preparation, the training, and a strategy. So share with the larger group what you told us, and where does the digital euro and the whole CBDC program fit into this transformation process?
Thank you very much, Yun. The truth is that I never did a marathon on my own. But first of all, it's really good to be here, part of this conference, doing this panel with my esteemed colleagues, Jacques Vicanta and Fabio. I have the pleasure that Frankfurt is so close to Basel, so for me it's just a 300-kilometer trip, 200 miles. And for many of you, I realize that I guess some of you are jet-lagged. You did such a long trip to come to Basel. This is wonderful to discuss this very important topic. I come back to what I did in that speech when you referred to the management conference, and I'm really happy that I gave some food for thought. I think we labeled this change of the Bundesbank Wandel. Wandel is the German, let me say, expression for change, doing something different. And I can tell you the tradition of the Bundesbank, a 70 years tradition, it is a challenge to change a central bank. And I'm not sure if central banks are really used to these changes. I think the last change the Bundesbank did, the most significant change, went back more or less 30 years ago. So when the board of the Bundesbank came back 2 years ago and explained to the colleagues, yes, we want to do something different, everyone was a little bit shocked that something is coming from top down and they want to change something. Often it was the other way around. But after 2 years, everyone is now completely aware of the fact that we have to change. And now I'm coming back to what we are discussing here. The world outside is changing. It's becoming more digital. And also the business model of the central bank is changing to a certain extent. Yes, I guess in 10 years, I guess the mandate of central banking will be the same. It's safeguarding price stability. But how to get there, all the instruments we are using, the services we are providing, they will be, it's my forecast, completely different from today. And so it was clear to me, to the whole, let me say, board of the Bundesbank, that we have to change. So what we did is that we tried to find out a way how to get there. I think it was clear that we have to change the way we are working together, overcoming silo thinking. This is of utmost importance. Then embracing new technologies. Also find the right people to do this. I think this is also a very challenging part. People with a different background. Not the typical background we have in central banks, that we had in central banks over many, many decades. And then also what we learned is that it's communication. It's all about communication. To really convince people internally, we did something good for the last 7 decades, but now we can do it in a different way, or we have to do it in a different way. So we started it also by changing internally all what we do in terms of processes, front-to-end process, how to make this more digital. So we became, let me say, a kind of a startup. Central bank, how to change things from front to end, using new technologies. We established a new department. So the new department head, she's sitting over there. It's about strategy and innovation, Camilla Holtgreve. So we are trying to find a holistic way how to do it. Now coming back to CBDC, this is what you asked me. I think what we learned over the last 10 years, and especially in Germany, we are very addicted when it comes to cash, using cash. But over the last years, yes, we see that there is maybe diminishing attractiveness of cash. So if part of, let me say, your core product is losing attractiveness, then you have to think about another new core product that is standing as a complementary product beside cash. We don't want to give up cash. But now I would like to see that we really get to a kind of a digital currency, the digital euro, that is being one of the most innovative CBDC you can think about. It should be innovative for wholesale, retail, when it comes to tokenization, when it comes to privacy. And I'm not a very patient person. Not a very patient person. And my colleagues, they know that I'm not very patient. So I think we lost some time already. And now I believe we have to speed up. And I'm happy to see my colleague from India, Shakrikanki, and I learned a lot what India achieved when it comes to digital currency. And I believe now we have the momentum in the euro system. And my friend Fabio and myself, we will push this. Bundesbank will play a significant role here, how to get to this digital euro. And I think it's a necessity to really get there. And beside that, we have to change central banking. And as I said, central banking in the future will look different.
Thank you very much, Joachim, for that sort of insight into your thinking. But I think what we all gained, from that dinner speech was, I think, the sense that we have to move. I'd like to turn to the second round, actually, and then turn back to you, Fabio. You can react to some of the things that have already been said. But one thing that I'd like to explore in the second round is something that you mentioned in passing, and also something that Joachim mentioned, which is tokenization. I think it links very much with the observation that you made that in the latest CPMI survey, we do see this greater emphasis on wholesale CBDCs. And in a way, wholesale CBDCs have always been around. I mean, they are the electronic versions of central bank reserves. But I guess it's the additional element of having this central bank money in the same venue as commercial bank money, perhaps other assets, that allow programs to be written referring to all of these elements together, which thereby giving it greater functionality. And the CPMI has been working very intently on tokenization. You have the Future of Payments Working Group. In fact, the G20 has tasked the CPMI, together with the BIS, to write a report on tokenization and the broader systemic impact. So I wonder, Fabio, whether you could share some insights into your latest thinking on tokenization.
Well, thank you, Yoon. This is a very important question, and you are absolutely right. Tokenization is the next step, the evolution of wholesale CBDC, and they have to be made compatible. First of all, let me say that the idea of tokenization is not new. There is historical research showing that tokens predate the invention of writing and are as old as accounting itself. What is new is the technology. Technological innovation affects the way tokens are created and traded, and will continue to do so in the future. Let me start with a very basic, simple, but important question. What are tokens? Well, generally speaking, a token is a representation of something else. So why do we want to use a token? Well, one reason is that the representation may be easier to use than the object it represents. To make this concept clear, let me use a simple example. Imagine that you go to the theater to a cinema and check, no, you don't go to a cinema, you check your code. You go to a theater and you check your code. You give your code and you receive back a token, a ticket, to take with you into the theater. And the token, the ticket, would fit easily into your pocket. It would be much easier to bring with you the token, the ticket, than your code. So in the language of economists, tokenization reduces frictions, such as those associated to storage, transportation, and exchange. Moreover, as you often remind us, money is a social convention. I would argue that the same goes with or for a token. Take the example I just gave you, the example of my code. I accept the token, trusting that the person behind the counter, the person who gave me the ticket before, will be kind enough to keep my code safe and return it to me after the show. But what happens if he or she doesn't? Well, this simple example illustrates that tokenization offers not just opportunities, but as always in life, also potential risks. To fully understand its opportunities and risks, we need to look beyond the token, to the platforms on which the tokens are listed, often using DLTs, the distributed ledger technologies. Platforms can, the fact that they facilitate a range of functions that are typically segregated in conventional market infrastructures such as issuance, trading, clearing, settlement, and asset servicing. This can lead to potential efficiencies by cutting out intermediaries and streamlining processes. But as I mentioned before, this also implies additional risks. For example, what if the token does not represent a one-to-one enforceable claim on the underlying asset? In that case, I cannot rule out the possibility that I may lose value to the underlying, relative to the underlying asset, or even end up with a worthless token if the asset is not there, if I don't get back my code in the end after the theater. An appropriate legal and regulatory framework to secure the link between the token and the underlying asset is crucial. For example, the legal status of the token should be clear, and conflicts of interest between the holder of the token and the holder of the asset should be clearly addressed. But the risks clearly go beyond the legal and regulatory dimension. We also need to consider settlement finality, access, operational risks, cybersecurity, and fragmentation across platforms, and many other potential sources of risk. Against this background, tokenization stands out as an opportunity for central banks to improve wholesale transactions in central bank money. As I mentioned earlier, many central banks are now involved in CBDC projects, in wholesale CBDC projects. Let me give you an example from the Eurosystem perspective, as the Eurosystem is experimenting new solutions based on DLT, and how these experiments could interact with the target services. The target services are the infrastructure that we use for interbank transactions in the euro area. So how this could be used to interact with target services to settle the euro cash leg of transactions in central bank money. One option we are currently examining is to create a technological bridge between the central bank's cash settlement system and the external private DLT platform that manage tokenized digital assets. This option focuses mainly on use cases such as delivery versus payment, secondary market transactions, and life cycle management of securities. But we are also exploring another option. That is an option based on the creation from scratch of a Eurosystem DLT platform for Euro central bank money settlement, combined with a technical interface between this platform and market DLT platforms. Based on this work, the Eurosystem has developed a framework to carry out exploratory work in 2024 together with the market. And the objective is to understand concretely what value added new technologies such as DLT could bring to wholesale settlement and capital markets, and how the different options compare from a business, operational, and technical perspective. Let me conclude by saying that tokenization is extremely important to the Committee on Payments and Market Infrastructure, to the mandate of the committee. As a standard setter, we continue to focus on the safety and efficiency of payment, clearing, and settlement. The core business of the committee will still hold. Its values will still hold, such as proper risk management, good governance, and clear and robust legal framework. But of course, this would be true whether tokens are used or not. Let me stop here. Thank you.
Thank you very much, Fabio. The importance of the legal framework, I think, reminds me of this of the saying that you quite often hear from the crypto community: "Code is law." But I think, Fabio, what you're saying is the law is the law, because you need some way of tying down the token with the actual underlying asset. In the same vein, Joachim, can I turn to you and perhaps pursue the notion of a unified ledger that you mentioned? Also, Agustin gave great prominence to in his opening remarks. This is the idea that when we have a tokenized platform, when we have central bank money, commercial bank money, and perhaps other claims all on the same programmable platform, that we can actually achieve greater functionality. What do you see as being the biggest benefits of such a platform, and what do you see as being the biggest challenges?
I think, first of all, unified ledger technology is a very promising technology. This is for sure. I guess it's much more than maybe a vision to use, or in the future that we can take advantage of the full scope of the unified ledger technology. I think it is really more than a vision. I used once, when we met in Washington during the conference, we had a different discussion about that, a quote that came from a former chancellor of Germany, Helmut Schmidt. He once said, if somebody has a vision, he should ask a help of a medical doctor. And so I believe it's much more than this, that DLT is for me not a vision. It's something we should really use when it comes to central banking. And it was many times we refer to the Agora project. Augustine mentioned this, also Francois. And Agora is a marketplace. Agora is the ancient Greek name for marketplace. And a marketplace that takes advantage of, let me say, bringing together the central bank community and the private sector. And it was already said by Fabio, there are still some, let me say, open question how to get to the right legal framework. But I guess these are obstacles we can try to overcome, we can try to solve. I do not see that this is, for me personally, an ultimate constraint, but we have to think about, because it also goes deep into national legislation. So it's not an easy something. This is for sure, but I believe it is really something we have to work on. And it is, as I said, not a vision for me, that maybe I hope in the near future, we will have a DLT-driven platform that is covering all the services and interconnections we could provide as a central bank community to the whole world. And it would be a huge mistake not to get into such a direction, not to work on this, having a better knowledge. And as I alluded to in my first answer, I think this is much more than maybe a kind of a thing we can work on this and really we can take enough time. I think we do not have this time. We have to really, as I said, to speed up on all this, because otherwise, if you would have asked me, I know it is recorded. If you would have asked me, if you would have asked me 20 years ago, is the central bank business model really, is it destroyable, yes or no? I would have said clearly, no. Now I'm not so sure anymore. And this is a reason, and that is the reason why we are sitting here. We have to work on our business model. And DLT is just a mean, or it's an instrument that could help us here to really get to that point.
Thank you very much, Joachim. In fact, there will be several sessions actually during this conference on tokenization. And I think we'll also hear immediately after this panel from Thomas Jordan the great strides that the Swiss National Bank has been making in the Swiss context on some of the sort of functionalities. And there's also actually, going back to the previous point on the importance of the legal framework, there's actually also a very important session on the legal framework surrounding tokenization. So enough of the advertising. What I want to do actually is now turn to Governor Das. Shaktikanta, you mentioned that one of the key sort of imperatives of your CBDC pilot program was to ensure interoperability between your retail CBDC on the one hand and the fast payment system on the other with UPI. And I think this is actually one question that we get a lot when we discuss CBDCs in the context of financial inclusion, in the context of the development of the monetary system. How do you decide whether you should put more effort into the fast payment system, the existing fast payment system, versus developing a new platform, a new instrument, and what are some of the synergies between the two? And I think, Shaktikanta, I think your experience shows that it seems that it is very much compatible, but presumably this is something that really needs a lot of consideration at the design stage. So perhaps you could share some lessons from your experience.
Thank you, Hyun, for raising these points, very relevant. And I must say that the interventions of both Joachim and Fabio have been very, very useful, and look forward to further deliberations and discussion on this matter. Now, I agree that there should be some connect between the existing fast payment systems and the emerging systems based on tokenized money, such as CBDC and tokenized assets, etc. In India, while rolling out our CBDC pilot, we have kept this aspect very much in mind. Benefits of tokenization are many, and the efficiencies are best realized when all components, that is, funds and assets, are tokenized. However, extensive study is required to substantiate these benefits. Further, token-based systems enable certain unique features which are currently not possible in the case of fast payment systems. Under the retail CBDC pilot in India, the feedback from the users reaffirmed the need for a connect between fast payment systems, that is UPI in our case, and the CBDC. We have combined the CBDC QR code with the UPI QR code and made it a single point of acceptance. We have also introduced interoperability between UPI and CBDC. Thus, if a customer makes a CBDC payment, the merchant can receive the money in his UPI-linked bank account if he does not have a CBDC wallet. On tokenization, I understand that there are several projects being undertaken by the BIS Innovation Hub in collaboration with central banks across various jurisdictions. It is generally believed that tokenization can improve efficiencies through atomic settlement, improved transparency, and regulatory compliance. It can also enable fractional ownership, efficiency in clearing and settlement, investor confidence, and possible cost reduction when deployed at scale. There are, however, potential challenges of technological scalability, interoperability, governance, accountability, etc., which need to be further deliberated. Having said this, let me also say that token-based systems present some unique advantages. Tokenization introduces two key concepts, namely smart contracts and programmability. The benefits from smart contracts and programmability arise from automation, which enhances efficiency, reduces reliance on intermediaries, and enables faster settlements. This, in turn, can lead to unlocking new possibilities in the financial system. For example, some functionalities like offline payments may be easier with a token-based CBDC than with a fast payment system, as tokens can be stored in the user device and would be available for transactions. On the other hand, in a fast payment system, connection to a central database would be required for every transaction. In case of programmability, token-based CBDC would allow a user to hold more than one type of token within a single wallet. Cross-border payments is also another area that is especially ripe for change and could benefit greatly from tokenization and unified ledger proposed by the BIS. Further, integration with smart contracts can enable execution of complex transactions automatically, fostering efficiency and reliability. I would now like to conclude by stating that in an ecosystem where both traditional and emerging technologies play an important role, interoperability between the two, that is fast payment systems and the new tokenized money, interoperability between the two will ensure that both work in tandem without causing a fragmentation. This would require a strategic and collaborative approach between central banks, financial institutions, and the fintech companies. The development of appropriate governance and operating framework spanning more than one country is a complex and very challenging, is a very challenging task ahead of us. I would like to urge the BIS to give specific attention to this area also, and we would be happy to be a part of that entire process of working further in this direction. Thank you very much.
Thank you very much for those insights. We are drawing to a close. Let me just give an opportunity to the panelists to come in with any reactions if they wish at this stage. But if not,
I guess Fabio.
Fabio, did you have something?
No, I only a very brief observation. I wanted to fully agree with Joachim when he mentioned that central banks in 10 years from now will be different. And I would expect that given the discussion we have had today and the importance of payments, digital instruments, there will be less economists, I'm sorry, Yoon, and more data scientists, more physicists, more cryptographers. The business will be the same, but as Joachim mentioned, the implementation of the mandate will differ substantially, and there will be a broader and more heterogeneous range of skills in central bank boards. But thank God I will be retired by then. Thank you.
Well, thank you, Fabio.
But
I think,
Yoon,
yes.
Yoon, maybe let me say, this is the reason why monetary policy in the Eurosystem is working so well, because Fabio and myself, we are agreeing on all the things.
I think, Fabio, what I would say is, data science, can be seen as a as a sub sort of area of economics. I mean, it is very much it is part of econometrics, statistics. So in that sense, I think so economists will probably be around. In fact, what I would really highly recommend are the sessions on AI, actually. We didn't really spend much time on AI on this panel, although we did cover many of the other areas. One of the really exciting prospects of Agora is that once you actually have a platform where you have commercial bank deposits and central bank money together in a programmable platform, many of the frictions that is currently holding back cross-border payments can see really quite substantial progress. And I think the one area where AI and machine learning is known to work is in these compliance heavy processes. And Morten Beck, who is leading the Swiss Center, will have more to say about this shortly. But for now, let me thank the three panelists for this great way of kicking off the event. And I think we learned a lot, and I think we've come away being inspired and being better informed than ever. And I think we're just about in time, actually. So why don't we give the stage to the next session, which is Thomas Jordan. So thank you.
Thank you to all distinguished panelists and to Hyun for an interesting conversation. At the BIS, currently, the code check system, can you hear me? It's not tokenized, but no worries, you will receive your codes back. And we will definitely consider it for next year's summit. I think we're all excited to see where the CBDC journey will bring us. Our next guest will speak about implementing a CBDC in a real world. Let me welcome the chairman of the Swiss National Bank's Governing Board, Mr. Thomas Jordan, who will showcase Project Helvetia III, a wholesale CBDC pilot.
Thank you very much, ladies and gentlemen. Let me thank the BIS, especially my friend Agustin Carstens, for the opportunity to present and discuss Project Helvetia III. It is a great pleasure to give you some insights into this pilot project of the Swiss National Bank. The pilot represents the world's first issuance of a wholesale CBDC on a regulated third-party platform to settle commercial transactions with tokenized assets. Helvetia III is a good example of how learnings from BIS Innovation Hub projects can be leveraged for real-world use. We started this work together with the Hub's Swiss Center and the private sector more than 4 years ago. In Helvetia I and II, we jointly expanded our understanding of wholesale CBDC and shared the findings with the central bank community. We took advantage of this groundwork to launch Helvetia III in December 2023, bringing Swiss franc wholesale CBDC from a test setting to real use. In my remarks today, I will focus on 3 topics. First, I will share some preliminary insights from the ongoing pilot. Then I will discuss 2 alternatives to wholesale CBDC we are currently exploring. And I will conclude with reflections on the response of central banks to tokenization. Now, the tokenization of financial assets is gaining momentum. Switzerland has emerged as one of the leading centers in the adoption of tokenization within the regulated financial system. This raises the following question for the SNB. How can transactions with tokenized assets be settled in central bank money? Settlement in central bank money is crucial for 2 reasons. First, it eliminates credit risks and minimizes liquidity risk in settlement, thereby contributing to financial stability. And second, it reinforces the role of central bank money as the anchor for the monetary system. Helvetia III pilots tokenized central bank money for wholesale use, often referred to as wholesale CBDC. Participating banks can use Swiss franc wholesale CBDC to settle transactions with tokenized assets or tokenized bonds on 6 digital exchange, SDX. SDX is a regulated trading and settlement platform for tokenized assets. Since the start of the pilot, 4 tokenized bond issuances and 1 secondary market transaction have been successfully settled in wholesale CBDC. Economically and legally, the wholesale CBDC used in Helvetia III is equivalent to sight deposits on the S&P balance sheet. Access to wholesale CBDC is restricted to banks and financial institutions which participate in the Swiss Real-Time Gross Settlement System, or RTGS system for short. Legally, wholesale CBDC is an alternative representation of sight deposits at the S&P. A key difference to sight deposits is that the pilot makes tokenized central bank money available on the same third-party platform where tokenized assets are held. This approach eliminates barriers in today's siloed financial market infrastructures. At present, financial assets and central bank money are usually held on separate systems that are linked in order to synchronize payments and asset transfers. With wholesale CBDC, as piloted in Helvetia III, assets and central bank money are instead closely integrated. This reduces the need for synchronization and reconciliation and facilitates programmability. This approach aims to realize the benefits of tokenization, but also poses challenges. I would like to discuss 2 challenges relevant for central banks: governance questions and fragmentation of central bank money, and share with you how we address these in Helvetia III. Let me start with governance. Issuing wholesale CBDC on a third-party platform entails a public-private partnership. The central bank delegates certain tasks related to the issuance and use of central bank money to the platform provider. This means that roles and responsibilities must clearly be defined, as must rights and obligations. In Helvetia III, the S&P delegates certain contractually agreed tasks to SDX. At the same time, the S&P retains control and monitoring capabilities over the use of its wholesale CBDC. Such capabilities are made possible by operational and technical means on the SDX platform. Let me now turn to the second channel, the fragmentation of central bank money. Wholesale CBDC creates an additional pool of central bank money which needs to be managed. If wholesale CBDC were to be issued on multiple third-party platforms, central bank money would be fragmented even further. Measures to mitigate such fragmentations are needed. In Helvetia III, participating banks tokenize sight deposits and de-tokenize wholesale CBDC through the Swiss RTGS system in a standardized automated process. For this to work seamlessly, the operating hours of the Swiss RTGS system and SDX are aligned. If multiple third-party platforms with wholesale CBDC were to exist, this approach could be replicated. De-tokenizing wholesale CBDC on one platform and tokenizing sight deposits on another would use the same process and would be facilitated by the Swiss RTGS system. The role of the S&P in this process would be to control the issuance and redemption of wholesale CBDC on their respective platforms. Now, my focus so far has been on project Helvetia III, which explores wholesale CBDC on a third-party platform. But there are other approaches to settling tokenized asset transactions. To understand the respective risks and benefits, we are examining two alternative approaches to wholesale CBDC. The second part of my remarks, I would like to describe them and offer a preliminary assessment. Now, the first alternative approach is linking the tokenized asset platform with the Swiss RTGS system. I will refer to it as the RTGS link. The second approach uses private token money, which is issued on the tokenized asset platform and which is bankruptcy protected and fully backed by sight deposits at the SNB. I will call this approach backed private token money. Now, the RTGS link employs a synchronized approach to settlement. Sight deposits and tokenized assets remain on different infrastructures. To settle a tokenized asset transaction in this setting, the transfer of assets and central bank money is synchronized by messages sent back and forth between the different infrastructures. This corresponds to the current process where central banks support links between their RTGS systems and other financial market infrastructures in order to facilitate safe settlement. An RTGS link could leverage existing functionality in the Swiss RTGS system. Central bank money would not leave the current sight deposit accounts, thus preventing fragmentation of central bank money. It would also avoid the governance questions arising from issuing central bank money on a third-party platform. However, an RTGS link would replicate the current process, which builds on synchronization. This might limit the ability to improve the status quo. Now, backed private token money, in turn, enables an integrated approach to settlement, whereby money and assets would be held on the same platform. It would be accessible to banks that already have access to central bank money, and it would have risk characteristics similar to those of central bank money. If the token issuer defaults, holders of such private token money have recourse to the central bank money backing it. Backed private token money would reduce the need for synchronizations, since assets and money would be available on the same platform. Depending on the design, it could entail fewer governance challenges with wholesale CBDC in Helvetia III, but fragmentation challenges would be the same. Compared to wholesale CBDC and sight deposits, however, backed private token money is not a direct claim on the central bank and thus requires a thorough analysis with regard to its regulatory treatment. Our work so far on the three settlement approaches suggests that they are all technically and legally feasible. They do, however, have different operational, governance, and risk implications, and they might differ in their ability to deliver efficiency gains. It will therefore be important to carefully assess the respective benefits and risks of the approaches in order to decide on the best way forward. Ladies and gentlemen, let me conclude. Technological innovations such as tokenization may help to make today's financial system more efficient. This raises the general question of how central banks should respond to tokenization. As with any technological innovation, central banks' actions must reflect its mandates. And these actions may depend on the relevance of tokenization for its domestic financial market. If tokenization of assets becomes mainstream, settlement in central bank money will be crucial. This will allow central bank money to maintain its essential role as the anchor of the monetary system and to continue to serve as a safe means of payment. The SNB is currently investigating 3 approaches to settling transactions with tokenized assets in order to understand and compare their respective risks and benefits. This will then put us in a position, should the need arise, to take an informed decision on the choice of one or perhaps multiple settlement approaches. Given that the tokenization of assets is still a niche phenomenon, central bank must address the question of whether and how they should engage at this stage. They can take a wait-and-see stance and only act if tokenization is adopted at scale. Alternatively, they can push ahead independently of market adoption and offer new approaches for the settlement of tokenized asset transactions at an early stage. Or they can proceed stepwise to identify the optimal solutions for settling tokenized asset transactions together with market participants through experiments and pilots. The Swiss National Bank is pursuing the 3rd option. Through our Helvetia III pilot, we are contributing to the private sector's exploration of how tokenization can improve the current financial system. The world's first issuance of wholesale CBDC on a regulated third-party platform underscores our commitment to facilitating technical progress while acting prudently and responsibly. Thank you very much for your attention.
Thank you, Mr. Jordan, for the showcase, the BIS Innovation Hub project Mandala on shaping the future of cross-border payments compliance.
Thank you very much, Kodruta, and good afternoon, everybody, and welcome to the BIS Innovation Summit. Now, Mandala is a symbol that signifies cosmic unity, balance, and harmony. It is the universe in its perfect shape, where all the stars and planets have lined up. So when it came to naming a project that related to compliance, we thought, well, where else can we go? We really need the Mandala of compliance. It's well known in the world of compliance that it's compliance checks and the processes are manual, they are complex, and they're slow. They cause a lot of friction in processes, and particularly in cross-border transactions. So we also found this actually in one of our earlier projects, in Project Dunbar, where we looked at international settlements of multiple CBDCs. And one of the findings from that project is that we need to pay more attention to compliance processes and how can we streamline them. So what we did is we partnered with a number of central banks, 4 central banks to be exact, as our core partners on this project. They are the Reserve Bank of Australia, Bank of Korea, Bank Negara Malaysia, and the Monetary Authority of Singapore. And I'd like you to hear from them right now. So if we can play the video, please.
MAS has been collaborating with the BIS Innovation Hub and Project Mandala. Building upon the purpose-bound concept, we explore a compliance by design approach.
The initiative explores the potential of encoding policy and regulatory requirements into a common protocol.
Reserve Bank of Australia is delighted to collaborate with the BIS Innovation Hub.
Bank Negara Malaysia is committed to this collaborative exploration to address key challenges in the space of cross-border payments.
Project Mandala could streamline compliance and holds the potential to enhance cross-border economic activity.
Compliance checks are automated through the use of smart contracts. This aims to enhance the transparency and efficiency of cross-border payments while remaining regulatory compliant.
This is an exciting project which will uplift the efficiency and security of cross-border payments.
We believe automation of regulatory compliance procedures could pave the way for international transactions becoming faster and less complex.
So there's our problem statement, and you heard the term compliance by design. And what that means is simply embedding compliance into an infrastructure such that when processes are run, the compliance checks are done automatically. So when we conduct transactions, the compliance checks are done automatically. And the proposal here is we propose to encode country-specific compliance in a protocol layer using smart contracts to be able to establish a system on a distributed ledger that can work with existing asset settlement systems as well as new and nascent technology. So it could work with, let's say, CBDCs as well as RTGS systems and jurisdictions. This was really about looking at how do we take new technologies to improve what we have today. So we wanted to really retain the requirements, the compliance requirements in each jurisdictions, and see how we can improve the process and automate that process. And the idea is that it will automate these compliance processes and streamline them, as well as really create transparency and some consistency in the process. So, same profile transactions will come back with the same compliance requirements, and there's no guesswork required. So commercial banks can benefit a great deal from a system like this, and central banks can also benefit in that they can use this system to be able to conduct real-time compliance monitoring if they so wish using the system. So this is how it works. Basically, a bank initiates a transaction from Bank A to Bank B. Usually they will exchange basic information such as the amount, the purpose of the transaction and the beneficiary details, and they will exchange that information peer-to-peer. Now, the Mandala protocol will then take that information and it will determine what are the compliance checks that are required for that particular transaction. And they could be multiple compliance checks. You could have AML-CFT compliance checks. There might be sanction screening, capital flow measures, for example. So there might be multiple, but it will calculate the same requirements for the same profile transaction. Next, it verifies compliance with these requirements. And this is done through a secure privacy-preserving method. So that was really important as one of the requirements for Mandala. Now, once the compliance checks are all completed, it will generate a verifiable proof that can then link itself to the transaction. And this, again, could be any transaction on an existing asset settlement system or payment system or a new one, such as CBDCs or maybe RTGS, as I mentioned. It will link itself to that transaction and it travels with the transaction from its origin to its destination along the entire payment chain. And again, that privacy-preserving methodology was really important in this case. So if you take, for example, the requirement to do sanctions checks or sanctions screening, you'll find that with the Mandala protocol, we could check that both parties or all parties to the transaction are not on any sanctions list, private or public, without revealing any of sensitive information through that process. So what have we found so far? Project Mandala is in its early stages. We are halfway through the project. We have our 4 central banking partners. We also is ensuring that we're adopting an agile approach in true innovation spirit. And so we're testing and learning as we go. And so one of the use cases that we tested just recently is a Singaporean entity lending to a Malaysian entity. And what we found through that particular use case is that we can cut back redundancy and we can halve the number of steps that commercial banks have to do in that sort of compliance process. And this is on this particular use case. And what we found is the reason for that in this particular use case is that the protocol can calculate the compliance checks concurrently, you can conduct the compliance checks concurrently, and because the information is linked to the transaction along the entire chain, there's no need to redo or recheck the documentation as you go. Now, for central banks, the tabulation of CFM in real time is a real leap to improve the compliance monitoring as well. We are conducting a second use case. It's on our website, and it's related to capital investment between an Australian entity and a Korean entity. We have a whole video explaining on how Mandala works on the website. If you're interested, we'd be very happy to talk to you about it. But the last thing I wanted to say on Mandala is it was really important for us to work, obviously with our 4 key jurisdictions and our central banking partners, but also with commercial banks in those jurisdictions. So this is a public-private partnership. And this was important because both central banks and indeed commercial entities will be, if there's promise in Mandala and it makes sense to the real world, will be users of this system. And so allowing the commercial organisations to also see from a very early stage how is it being developed, provide feedback on what's required, ensuring that it is actually meeting their requirements as well, we can create something that potentially builds a bit more reliance and confidence and trust into something that public sector and private sector can use. So wish us luck with trying to find the Mandala of compliance. We will keep you posted with the updates, and thank you very much for listening.
Thank you very much, Maha. On a similar note, let us now turn to another BIS Innovation Hub project in the cross-border CBDC space, Project mBridge. This showcase will be presented by Ms. Benedict Nolens, head of the BIS Innovation Hub Hong Kong Center. The floor is yours, Benedict.
Thank you, and I'm fully aware that I am really standing between your drinks and this presentation. So I will keep it short. So this is an update on Project mBridge. So let's go back to what Project mBridge is. It is a shared payment infrastructure that uses CBDC, in particular wholesale CBDC, of the participating central banks to achieve instant cross-border payments. So having listened to the panel just now, a lot of the concepts that they talked about, wholesale CBDC, one platform, interoperable by design, settlement finality, 2-tier, atomic settlement, that's what we're seeking to achieve with the mBridge. So in terms of the history of the mBridge, it goes back to a proof of concept in 2021, then a prototype and a pilot in 2022, continued development and testing throughout 2023, 2024, and now we are quite close to reaching the MVP stage, or the minimum viable product. That's what MVP stands for. The mBridge has been built on 3 key pillars. We always thought it is critical to not just think about technology, but to think about legal and governance. And we thought about them in parallel to thinking about the technology. It is often that you develop a technology and then you realize you're missing the legal and the governance aspect. We did not want it to be there, so we have a parallel process. So let me elaborate on each of these 3 tiles. So the first one is the technology. It is, as you might know by now, if you've read the reports, it is a decentralized network. That means it is built on distributed ledger technology, and each of the central banks is operating a node. It is open sourced to the participant central banks. That means that the participant central banks each can check the code, penetration test the code, review and audit the code. It is Ethereum virtual machine, or EVM, compatible. What this means is that any smart contracts that are built on Ethereum become interoperable with the mBridge. So let's see if at any stage these smart contracts that are being developed, for example, for automated market makers, come to the right level of maturity to be usable in a central banking context, then there is already this compatibility. The system is also ISO 20022 enabled. This is very important for new financial market infrastructures, as it is the new standard. The system is privacy preserving. What that means is that every central bank only sees the transactions in its own CBDC, and that is very important. As I mentioned, the central banks are deploying the validator nodes, and each of the 4 participating central banks has deployed their validator node already. And then lastly, the commercial banks deploy ordinary nodes. I will show you a demo towards the end of this presentation. So now let me move to the exciting side, the legal side. Someone said the law is the law. And my background actually is in the law, so I'm quite passionate about the law. In sum, we have 2 key forms of agreements here. One is between the central banks and the BIS, and we call that the multilateral project agreement. This project agreement can be acceded to by new central banks through the accession instrument. It is a document attached to this project agreement that new central banks who want to join the project as a participant can execute. Secondly, we have the framework for the commercial banks, because I think we have some commercial bank representatives here. That is called the adherence agreement to the rulebook. And the rulebook has 2 core components: the platform terms, which are the key legal terms that govern the interaction of these commercial banks and central banks on the platform, and secondly, the technical terms. The technical terms for this system are quite voluminous because the system is significant. So let me now turn to governance. So we've also completed, as mentioned, a governance framework. It sets out our current governance structure, which is a committee-based structure. It also sets out our decision-making, including what we do with consensus and what we do through voting. So that is the key to the governance framework. In terms of the committee structure, we currently have a steering committee that is supported by 5 subcommittees. The 5 subcommittees cover the following 5 areas: technology, legal, policy, business, and risk and compliance. So with that, I will turn shortly to a demo. I would note that this is still the platform that is on the testnet. It will continue to evolve. Some of the functionalities will continue to be designed and continue to be developed. So you can now turn to the video, please.
This is a demo of the mBridge platform user interface. Please note that what you will witness are dummy transactions and no real data is involved. For the sake of time, all interfaces have been logged in and wallets have been issued with CBDC. Let's first look at a central bank's view. In this case, it's that of the HKMA. As you can see, the interface has a dashboard that provides summary statistics of the transactions on the mBridge platform. On the left-hand side panel, we can see the various functionalities available to the central bank, including access approval rights to onboard selected domestic commercial banks, and the ability to set transaction limits and parameters, such as the maximum amount they can hold in their wallet or transact in a single cross-border payment. Central banks can also set alerts for foreign exchange rates agreed outside of a predetermined rate range for all currency pairs on the platform. They can also approve CBDC issuance and redemption requests and see their commercial banks' on-bridge balances and transaction details. Here we have a Hong Kong commercial bank's interface, and suppose that its Hong Kong local corporate client wants to pay for the import of coconuts from a Thai corporate and has agreed to pay 400,000 Thai baht. As of now, the Hong Kong corporate's bank on mBridge has no e-Thai baht, so it initiates an FX transaction with a Thai bank to exchange e-Hong Kong dollar for 400,000 e-Thai baht. The maker enters the details, including the exchange rate that was agreed off the platform, selects the counterparty bank, and verifies the transaction with its security PIN. A series of compliance checks will happen in the background. The transaction then goes to the checker, who verifies the details and authorizes the transaction with the 6-digit PIN before it is sent to the counterparty Thai bank. If we now turn to the Thai bank's view, we can see that it has 10 minutes to accept the transaction, as shown here, after which the transaction will automatically fail if no action is taken. The Thai bank reviews the details and confirms the transaction. The atomic PVP exchange of both legs of the FX transaction now takes place. Within seconds, the transaction is added to the blockchain ledger once the block is validated. It is marked as successful, balances are updated, and the transaction is settled with finality. If we now go back to the Hong Kong Bank's wallet balance, we can see that its e-Thai Baht balance is updated to 400,000. With this e-Thai Baht in its wallet, the Hong Kong Bank can now pay the Thai corporate's local bank on mBridge 400,000 e-Thai Baht for the coconuts. After inputting the transaction details and completing the necessary compliance and authorization checks, the payment is sent to the Thai corporate's local bank within a matter of seconds, and the cross-border payment for this international trade transaction between Hong Kong and Thailand is settled. This demonstrates the potential of faster, safer, cheaper, and more accessible cross-border payments on the mBridge platform.
Great. So let me finish with the future vision. So Project mBridge targets to enhance efficiency and access to cross-border payments by connecting interested central banks and commercial banks around the world as a public good. And this is particularly relevant in our view for EMDAs, where the correspondent banking withdrawal has been the more acute. The MVP platform obviously will continue to evolve based on the learnings derived from real value transactions on it during the MVP phase. And to achieve this, we encourage more central banks and more private sector participation. And with that, I will conclude with what Agustin said. We have to take small steps and giant leaps. I don't know where the mBridge lies, if it is a small step or a giant leap. I would say maybe a medium leap. But let's see if we succeed, in which case it could be a giant one. Thank you.
Thank you, Benedict. We will now have a 45-minute break. Let me invite you to enjoy the coffee outside of this room. Also, feel free to use the quiet innovation lounge on the ground floor. We will reconvene at 3:55 sharp. Thank you. I'm so thirsty.
Well done, writing jokes on the fly.
My God. Welcome back, everyone. We will now continue to explore the concept of tokenization in more depth. Let us first start with a fireside chat on tokenized private money. For this, I invite Ms. Joasha Popovic, Associate Editor and FinTech Subject Specialist at Central Banking, to moderate the discussion.
Good afternoon and welcome to the panel on tokenized private money. Welcome also to those watching online. So thank you for the warm welcome. My name is Joasha Popovic. I am Associate Editor at Central Banking. And I am pleased today to be joined by Dante Desparte and Umar Farouk. Dante Desparte is Chief Strategy Officer and Head of Global Policy at Circle. And prior to joining Circle, Dante served as a founding executive of the Diem Association, which was a blockchain payment system proposed by Facebook, which met regulatory barriers before abandoning its stablecoin Libra. And And Umar Farouk is the CEO of Onyx by JP Morgan and the Global Head of Financial Institution Payments. So Onyx, launched in 2020, is the first bank-led blockchain for the exchange of digital assets, which are settled using the JP Morgan coin, also a stable coin. JP Morgan reports that it has over 40 participants on Onyx, including large broker-dealers, and processes up to around $2 billion daily. So Circle manages USDC, which is a stablecoin pegged to the dollar, used on over 16 blockchain networks, with a reported combined daily trading volume of around 680 million on primary and secondary markets. So just by way of brief background, we've talked about tokenization today, so it's the digitization of claims on programmable platforms. Believers say it will revolutionize the financial system. However, given there are problems in decentralized finance, such as stablecoins losing their parity with the dollar and a lack of transparency around reserves, as well as, of course, crypto's notorious volatility, could tokenized bank deposits meet the needs of an evolving financial system? So these are some of the questions that we're going to be exploring today. So I wanted to start with you, Dante. What form and what role do you see for tokenized private money in the future of money? And what changes do you think might be needed to digital financial infrastructure?
Well, first of all, it is a real pleasure to be on the stage and to have been invited into the inner sanctum here at the Bank for International Settlements. So I guess I would start with a speech by a central banker as a way of answering this question, which is Sir John Cunliffe, who was one of the contemporaries at the Bank of England when the now infamous Libra project was launched, later referred to the project as a warning sign to central banks and banking more generally, and referred to Libra as black ships on the horizon. And as a captain of one of those black ships, and despite the fact that we never quite found safe harbor, but nonetheless, I'm very happy to be on the stage. What I can say is that the vision and the business model in many respects is vindicated by a couple of things. And that's perhaps the experience of a company like Circle and the many debates that Umar Farouk and I have had around the world, is that convergence is the better outcome of this technology rather than disruption. So when crypto first emerged on the scene, it was in the smoking crater of the 2008 financial crisis, and it was supposed to be an anti-establishment technology. And what we have seen, though, is that in the United States, the digital asset industry is heralding the advent of tokenized money market mutual funds from none other than Wall Street entering the market. And at the same time, as you probably hear from Umar and I, while we have had several debates around the world about tokenized deposits or payment stablecoins and which business model would be the best, the fact remains is that the closer these products and services get to central banks, the better they will be to fulfill the unmet needs that the central banks themselves, we heard this morning, are trying to achieve. universal financial inclusion, relevance in the 21st century and beyond. Your and my financial needs don't take a bank holiday, but if to be banked hinges on brick and mortar, we all have a problem. And I think that's the key for me. And perhaps the last quick point I would make is definitionally the only admonishment I would make to the central bankers in the room today is we have to update the definition of what does it mean to be a bank. Because all too often the provision of these innovations in financial services through the two-tiered banking system precludes the participation of regulated non-bank actors who could either provide critical technology or critical capabilities like a company like Circle could in this common objective of upgrading the modern economy and the financial system. So I bring an olive branch and a message of convergence as opposed to disruption.
Uma, question to you. So similarly, what roles and what potential do you see for tokenized deposits and stablecoins, and what are your views on the optimal future state of digital money?
So first of all, again, thank you for having me. I will also start with a Libra-related story, which is I was here in 2019, I believe, and the Libra team and the JPM Coin team, and I think Finality team were invited to speak about the respective projects. And I remember it was a bit of a strange format because each project got to go separately into the room. It was sort of like, being on trial. And I remember the Libra team going in and not coming out for a long, long time. And you're like, I don't know what's going on in there. But, but then I went in after, and there was some fear in the system. But now, it seems like the fear has been dissipated. So again, I actually would fully agree with Dante, which is, I think whether it's convergence or coexistence, you can't, it's not an either or proposition. So at the end of the day, leaving aside digital currencies, if you just look at money in general, you basically have central bank money, you have commercial bank money, you have private money. There's all different tiers of money, and people in this room, most of them are very familiar with that infrastructure. So if you think about even in the US, for instance, you have obviously the dollars that the central bank issues. Then there's commercial bank money, which is JP Morgan, Bank of America, and all the thousands of banks in the US. And then there's things like Venmo and PayPal and all that, and that's also, or Apple Pay. I mean, that's also money. That's a different tier of money. I would argue that most of these not only coexist, but they actually slightly serve different needs. They have different levels of innovation and different use cases, so they all should be able to exist. I think where we will diverge a little bit is, I think you also have to keep in mind that you do not end up creating regulatory arbitrage in the system. And what I mean by that is, if you want to move a dollar from, say, New York to some other location around the world, there is a lot that goes into that process, and a lot of that is because of legal and compliance and all of those things that we have to do. I think as Project Mandala was presenting, those are some of the issues that are being resolved. And I think if you think about sort of whether it's crypto tokens or stable coins, when they are moving around, in many cases there are folks, I think actually I respect the Circle team quite a bit. I think they've really thought this through, but there's lots of people out there who are moving this with, frankly, no oversight. And it's only a matter of time before something really bad could happen, and that would have an impact on the entire system. So I think you have to really think about two things. One is reg arbitrage, which is how do we avoid that? I think a part of that is obviously regulatory clarity, as in what is this exactly? And then also, I think, as Dante said, yes, you can get closer to the central bank, but I always think of the central bank as, sort of the closer you get, the more highly regulated you become, because the closer you are to possibly blowing up the entire system. So you need to make sure that no matter how close someone gets, they are being held to the same or at least similar standards. So I think that's one thing. I think the other thing which I would say, based on all the stuff that was said so far, is you do need to separate the technology from other aspects. So there's a technological aspect that could solve things like, inclusion. If people don't have access to a digital means of money, yes, introducing one from a central bank, especially in an underdeveloped economy, could have a significant impact on inclusion. However, I think you have to separate that from what is inside it. So why people might want to hold a stable coin or even crypto in many countries is not because of the technology, but because of the access to hard currency. So, if you really think about it, many countries, if you are sitting in a country with extremely high inflation or hyperinflation, you don't want CBDs, you don't want, Circle or USDC or any of these coins because you think the tech is cool. You want them because you're getting USD. And a lot of those government, central banks may not want that. So I think a lot of these issues have to be resolved, and you have to separate those two, because sometimes we end up conflating them.
Great. I should also mention that the format for this session is slightly different, where we will actually have a chance for audience questions. So please do have a think about what questions you might want to pose, and hopefully we'll have a lively debate. So moving on, Uma, I wanted to follow up and ask, so with regard to interoperability, what challenges are there of digital money between tokenization platforms and traditional finance systems, and how can these be solved?
So I would take them a little bit differently, which I think, as you were going through, or Dante, you were talking about it, there's more than a dozen blockchains that USDC is available on. I think it's actually a common misconception by people who are not close enough to the ecosystem, that they think that there's like one big thing out there, whether that's Ethereum or whatever. In reality, there's lots and lots of chains, and it's still unclear how many of them or which of them will actually emerge victorious. You could argue that Ethereum would be one of them because it's very big right now. That's why a lot of the project, including mBridge, uses EVM compliant. We do EVM compliant stuff. But that doesn't mean it's going to win. I mean, there's them, there's Aptos, there's Solana, there's Polygon. You can just go on and on. And so there are proven technological means to make them interoperable. They're all ugly. Like every single one of them has friction in them. So I think actually, if you really want to do transactions across them, you have bridges, et cetera. And frankly, if you go back and read pretty much all the cyber incidents that have happened, attacks as well as compromises, they almost always happen at that seam when two systems are trying to talk to each other, because you create these very attackable sort of frontiers at that point. So I think that's one, which is just technologically there's ways, but nothing is perfect so far. The second thing is actually interoperability between that and the traditional financial system. That is a harder problem to solve. And for us, we run a blockchain infrastructure that, again, moves billions a day, but not trillions that we move in our regular infrastructure. And that talks to our traditional infrastructure, which is, core banking, our general ledgers and things of that nature. That is a tougher one to solve, because most of these core infrastructures neither are performant at the same level that blockchain is, in terms of how much transaction you can push through and how quickly it happens and how settlements work. And also, most of them are not 24/7. So most of them have cutoff hours, and they might be 5 days or 6 days a week. And so how do you actually make two things talk to each other when one of those things is off for a certain amount of time, but the other thing stays live, is a real technological as well as legal problem to solve. Even something as simple as value dating, which again, people who want to get really tortured by banking can really read about and think about, is, what happens on a Monday? Did the transaction happen on a Monday or a Sunday or in Singapore or New York? I mean, all these things get very complicated. So I think, again, we will get there one day, but for now, these are mostly issues that are somewhat unresolved. So, we basically do it by making sure that the two layers are synchronized at some interval, that the total is always synchronized in real time between the two. But if you really think about, let's say JP Morgan and Bank of America both had the equivalent of, we had JPM coin and Bank of America had, Bank of America coin, I'm just making it up. To settle those two is actually a real complicated endeavor without having either a real-time ledger at the back, a wholesale CBDC at the back, or a 24/7 RTGS system. So again, all of these things have to be resolved. Again, you heard that, especially from the Swiss National Bank. I mean, a lot of these things are being worked on, but these are tough problems to solve even within a commercial bank, let alone going to the central bank infrastructure.
Dante, so going to you, we've heard a bit about the problems. I'm just wondering what kind of innovation you're expecting to see in the space for the rest of this year and early 2025.
Yeah, I think, ultimately, I can't help but put the mirror and hold the mirror up, because the audience represents one of the most critical stakeholders that really matters for the innovations that we all care about, which is that we talk about technology neutrality, activity-based regulation. But what I think the last 5 years in this industry has witnessed amongst many policymakers is the permission versus forgiveness tension always gives out. And that has precluded many countries, many banks, and many central banks under the guise of protecting their economies and the banking system from spillover risks, from actually witnessing this constantly upgradable financial market infrastructure that Umar just rightly described, right? That instead of having a standards war that caters to closed, walled garden payment systems, the world has enough PayPals. If you were lucky enough to be born in the right postal code, you have access to a comparatively fast payment system. But then there's a whole portion of the planet that if, again, to be banked is about brick and mortar would be on the edges, those technologies are actually patently easy. And actually, we should all be grateful for the fact that they're proven to be constantly upgradable. Public blockchain infrastructures collectively have ledgered trillions of dollars of economic activity, and it proves that it in fact works. The industry and the technologies have also solved their mini Y2K moment with the Ethereum merge to move to proof of stake over proof of work. The question, though, is to many an industry player, they've learned the hard way that the central banks and the regulators have infinite authorities and no statute of limitations. But yet we have not encouraged broader cross-sector collaboration that includes non-bank actors. That's the key theme, because I think the tech works. Digital wallets have enabled stablecoin transactions in more than 191 countries in just the case of a company like ours. And what we've also proven is that this is an imminently partnered business model, that the value chain of digital assets and therefore the value chain of tokenized money presupposes complete interoperability under the watchful eye and invisible hands of central bankers with the prudential risk management that you get from the banking balance sheet. But there's some risks there that go both ways, as we learned about in the United States and you learned about here in Switzerland with Credit Suisse. You wouldn't want a deposit token, for example, issued from any one of those banks that recently failed. And then lastly, you ultimately want this last mile to overcome the walled garden problem that we have in payments, which is that a fast payment exists to the extent you're lucky enough to be inside the walled garden. But if you want a fast payment at the extent of world reach and world scale, you actually need to use open systems from end to end. And all of those open systems can be a reflection of a prudentially managed structure, which I think we've proven.
Okay, great. I'd like to open it out to audience questions. So just looking out around the room, we've got a hand at the back. Is there a mic? Yes, great, thank you.
Hi, thanks. Mark Staples from Australia. This morning, Thomas Jordan from SNB talked about a form of private money that was a kind of alternative to CBDC. It was a reserve-backed digital currency, but a privately issued one. But he said it could be bankruptcy remote. So I'm curious if you have any thoughts about whether or not it's important for settlement instruments to kind of be bankruptcy remote, in the sense that they survive the bankruptcy of the bank that's issued them.
I think at the end of the day, I think Danny made that point. I mean, there's good guys and bad guys, and banks that are prudently managed and maybe they're not, and you can fail. I do think, though, there are certain kinds of instruments that need settlement in central bank money. And if those instruments are being created, you can do them through how we do them today, or you can do them through what was discussed earlier in terms of a bankruptcy remote structure. I don't think that's an exclusive one, though. At the end of the day, most transactions are happening in commercial bank money. And so even though, to some extent, yes, has there been failures? Yes, there have been failures, and for better or for worse, most of the people in the failure were protected. You can argue that, in many different ways, obviously. But ultimately, I think that has to be one of the options on the menu. So the way, again, I think about this is you have a commercial bank option on the menu. You could have a stable coin or some other kind of private token option on the menu. You could also have a central bank CBDC or a bankruptcy remote infrastructure. I know Finality is somewhere in the room. I saw Ram earlier. I know they are trying to do something very similar. So again, I think there's all these flavors of money, and it will depend upon what the use case is, because people might prefer a central bank option or a commercial bank option for the kind of transaction they're trying to do.
Yeah, and the only additional point I would add to that is law matters more than technology. I think we heard that in the earlier panel for sure. In the US dollar, it's emblazoned with the words "In God We Trust." To the crypto utopian or anarchist, "In Code We Trust" would be their point of their public declaration. But it all turns out that unless you can enforce that upon the issuer and the holder's rights are preserved in some manner, then it may be meaningless, just as we have money that isn't worth the paper it is printed on. We have had in this industry many, many, many tokens issued with no worth whatsoever. And so one thing that is encouraging, of course, is around the world, most major economies have rules that enshrine in law. For example, on the other side of the Swiss Alps in Europe, under MiCA, an e-money token has certain treatment and certain classifications that in some ways are even more conservative than banking. In the US, the draft legislation for stablecoins would require that a bank that issues a stablecoin do so from a different balance sheet than the banks to not subject the stablecoin to asset liability mismatch. I think these developments are much more encouraging than what you would see in the tech alone.
I've got a hand in the middle here. I've got a few hands actually, which is great to see.
Thank you. In terms of the inclusion, what do you think needs to take place to onboard the next billion people in any kind of commercial transactions? And maybe second thought, what could this audience or these institutions here, the traditional ones, make to enable it?
Sure. I mean, I'll start with a joke. I tried. I had a couple billion users with Libra, but
I know, and I support it.
I joke. Exactly. Next year I'll sponsor the conference. No, I think the good news is about the financial inclusion use cases is it actually analogizes quite powerfully to the way we have seen the decoupling from fixed line telephony to mobile telephony, is that there's a user base that would not have been achievable to service if the infrastructure stayed exactly the same. And I think we see analogies very, very similar to that around the world. We also see, frankly, that there's a developer ecosystem in the current iteration of this industry that is building the infrastructure to reach the end user and to reach the last mile in very encouraging ways. One of the most powerful use cases we know about and we've partnered on was, of course, with the United Nations High Commissioner for Refugees in Ukraine to deliver digital disaster assistance in a situation where the actual physical infrastructure and the banking infrastructure ceases to operate or is in the wrong hands. You now have this optionality in the payment system that I think is a really crucial part of the conversation.
Yeah, I would only add, I think, again, coming back to my point of separating the tech from the underlying currency, et cetera, I do think you run into the reality of how money works in the world. So there are big economies that obviously want to control their own monetary policy. They want to control what access people have onshore in terms of currency. There's capital controls and all these things. So yes, I mean, you could onboard using technology. A lot of people, or if you're in a Ukraine or any other war zone, yes, everything's collapsed. So you need something, and this technology could be a good way to get it there. But if you wanted to onboard 1 billion people, I would still argue that if you're operating in a world where the currency of that specific country issued by that, the central bank of that country is paramount and is part of their law, governance policy, et cetera, you always will see probably a bigger take-up with the likes of a UPI or other infrastructure like that, a centralized infrastructure being pushed down versus not. I'm not arguing that's a good thing or a bad thing. It's just that's the way to do it. I mean, I think India has written a chapter on that using actually public infrastructure. China has written a chapter on that using not non-public. So I mean, again, if you look at China over the last few decades, I mean, they leapfrogged using Ant Financial primarily, which is a private institution. So again, there's ways to solve that issue. Trying to do it through a distributed ledger at a retail level, it's very hard to disaggregate that from the monetary policy.
Got a question on the end over there.
Thank you. Brian Zhang from the Cambridge Center for Alternative Finance. So the concept of unified ledger has been mentioned several times at this summit. I wonder what the panelists think about this concept and what forms of digital money should a unified ledger include and why? Thank you.
So I think, first of all, because Mr. Carson is sort of the the resident host as well, sort of from the country. We have to like unified ledgers. But in all honesty, I think you almost need something like that. I mean, it's actually almost a necessity, because if you look at the public, and I'm sure this is one Dante and I will disagree on, but if you look at the public blockchain ledgers, they are not fit for purpose for large transactions today. And I'll tell you why. Let's say we were doing a transaction worth $100 million, and we were sending money, 100 million, let's say ourselves and UBS, just making it up, the two banks. If we are sending 100 million to UBS on Ethereum, there are validators who are validating the transaction. Now, what if something goes wrong? Who do I sue? I mean, you can trust in code all you want, but you can't really go to, there's no code court where you go and really have a discussion. And you need those sorts of backups. If someone loses your coat, but you still have the ticket, you want to be able to call someone at the end of the day saying, what the hell, you lost a very expensive coat. So I think at this point, maybe public infrastructure will get there one day with things like verifiable credentials, but that path is far away. And you need to get somewhere where people can do trusted transactions between financial institutions with some sort of accountability in the system. Whether that happens through unified ledgers or otherwise, it remains to be seen. But frankly, unified ledgers, RLN, mBridge, they're all trying to do this. Frankly, we have another project going on called Global Layer 1 at the MAS with Citibank and others. So they're all sort of shades of the same thing, which is you need some sort of a regulated financial infrastructure, and that financial infrastructure should be open to public institutions like central banks, should be open to private institutions like banks or non-banks. I mean, it should be the world's global layer for money movement. Otherwise, you just will always be in this thought process of being in silos. Not to mention, I think all these silos have native tokens, and I won't even go there. That's a whole different issue as well.
So I have to start with a small joke, which is that it looks and feels a little bit like Libra.
I think you should stop mentioning.
Look, I figured I'm going to own it. I'm teasing. But now the serious comment, of course, is that the idea makes a lot of sense. But in my humble opinion, I think oftentimes we're going for marginal improvements on things that already have all kinds of institutional advantages. And the only reason you don't move money any faster, arguably, is either because of a lack of will or because it's a pathway for monetizing speed. Speed in the banking system is a premium service. I pay people to get out of money faster, but I still can't execute a transaction on nights and weekends and in bank holidays. The other thing that a unified ledger conversation almost entirely ignores is geopolitics. You don't weaponize a currency, you weaponize the rails on which currencies ride. And I think all too often, while the central banks are doing really the Lord's work in figuring out how to modernize payment systems and money, the geopolitical reality is cross-border payments integration of this kind is often a line too far for national security interests. And that's the unfortunate piece of the puzzle.
Gentleman at the front.
Okay, we see the future as a sort of a struggle between, on one end, the idea of regulation and control, and the other side being placed by innovation. If you could take out a crystal ball here, what would you say would be the balance point that you would expect to see in the next decade, for example?
Yeah, it's a very good question. In the next decade, my sincere hope is that we're no longer talking about the technology. You know it's still early when you're still describing the technology and the technology as a protagonist. When was the last time we all went to an internet-related conference and spoke about hardware and software and the routers that make the internet possible? It's faded into the background, not dissimilar to cloud computing. Cloud computing, when it first became a thing, was terrifying to IT departments whose job security depended on keeping the servers plugged in and occasionally updated. And then all of a sudden, this core infrastructure becomes universally accessible, almost indispensable to both public and private stakeholders. And it's now a background technology. My sincere hope is this same future of money, digital currency conversation becomes background and what people care about most, and where I think the central bankers have the biggest stake, is outcomes. Our payment systems are slow, they're sclerotic. In past debates with Umar, we've had the displeasure of being at opposite ends of each other. I won't say who won those debates, but there's a video on the internet.
the second one.
Round one, he beat me.
Yeah.
But luckily, that video doesn't exist. It was all Chatham House. There's a whole host of things that we simply cannot achieve if we keep using the same analog infrastructure and all of the rest. And so I think we're still in the zeitgeist phase of the tech being the protagonist. But soon enough, 5 years from today, you'll have open public blockchains with Visa-scale transaction throughput. And therefore, the end user wallet experiment will be tech neutral. It'll be the activity that matters most. And I think regulators, policymakers, and central banks will be very well served in regulating the activity and not the technology.
I would agree. The only thing I would add is I think they need to become true public goods to be seen that way. Yep. And the reason we are stuck in technology is not just because we are early, but there's a stake that the technology owner has. Again, coming back to the token issue, which is I have a blockchain, my token is ABC. I really want to attract everyone to my blockchain because that's how my token goes up. So I think while tokenomics is an interesting concept, I think the core of tokenomics also makes it very hard to converge. I mean, think about it. I mean, the internet was developed as a public good. Now, it came out of all kind of military research out of some universities. But right now, no one really thinks about the price you're paying for an email you're sending. There's something in the back end, but it's a very minimal price. So I would argue, I mean, with all its flaws and positives as SWIFT, CLS, like a lot of these infrastructures that are gigantic infrastructures are actually seen as public goods, same for RTGS systems. So I think we need to get to an evolution point where the technology starts to be seen as a public good versus as a means to enrich, the group that sort of, owns it but doesn't own it because code is paramount, but then there is humans who are making money from the code. So, yeah.
Okay, gentleman here.
Regulatory arbitrage was mentioned, different tiers of money, attacks happening at the bridge, closer you get to the real thing. It seems to me that there might be ways in which we could rethink the ways in which we think about systemic risk. Is that where we're going with this, and how should we start rethinking that?
Yeah, it's a very good question. Because of course, as much as it, and hopefully the convergence message that I started with resonates still, otherwise it'll be a very lonely happy hour for me at my hotel. The question of systemic risk in the space is a very, very real issue. Just look back at the last couple of years. In the industry, they call it an ice age, a winter, I call it an ice age, right? In the last few years, the industry lost $2 trillion. This is just in digital assets. Most of which were not losses necessarily triggered by the technology, but by good old garden variety fraud and arbitrage and race to the bottom behavior. And the actors that have had the exact opposite operating models, hence the message about activity versus technology, have weathered the storm comparatively well. And where we now see the new version of systemic risk emerging is actually in the domain of bank to non-bank convergence of risk. And so my message to unfinished regulation and lawmaking is we have three choices left, particularly in the United States. Regulate, legislate, or designate. And in the designate category, you could either designate actors or technologies in the space as systemic or as national security threats. And we've seen precedent for both. But what's clear to me is that the more you get this within the perimeter, within the purview of central banks, and clearly articulating the line where fin ends and tech begins, the better. The better for outcomes, the better for markets and all participants.
Yeah. Following on from that, actually, I'm just wondering what limits do you both see to minting JP Morgan coin and USDC with respect to financial stability?
I mean, we don't really mint because we effectively are operating a deposit at JP Morgan, which is general liability. So, it's the only cap is how much my internal treasury team would let me do, which is quite a high cap. But, and again, it's an interesting sort of, similarity, which is it is a deposit, so it's no different, but I still have a cap designated by JP Morgan Treasury and CIO, primarily because they are like, this is new technology. So I think that's why I think we increasingly need to get away from the technology debate into what this thing actually is. And I think it also plays back into the previous question, which is, I think getting into some sort of perimeter somewhere is very important, in or out, because we are operating in a bit of a gray zone, and so those usually don't play well in the long term. If something goes wrong, like it did with FTX, et cetera, I think people had differing reactions. I mean, one is we could have probably overseen it, and we could have probably had consumer protections around it, and maybe that wouldn't have happened, or maybe it would have happened because even banking has problems like that. Or, the other approach which many people took was like, see, we protected the entire system from the meltdown. So again, I think, we need to think about what choices we want to make here.
I won't ignore the minting question, but I would just say, in hindsight, a market regulator telling consumers to put on their seatbelt after a crash is like the plane crashing and the captain putting on the seatbelt sign ex post facto. I think minting of a market-facing payment stablecoin, which is what you would call USDC in the United States, or an e-money token in Europe, is actually a market-driven activity. And so that's one point, meaning I don't think of these products as competing with the deposit base of banks at all. The second really critical feature of stablecoins as payment innovations is that even a comparatively small total circulation can support a lot of economic activity. And so the upper bound, in my opinion, is perhaps in the hundreds of billions of dollars. We already see that today. The question is, how much of it ever comes on shore inside the currency zone or jurisdiction of which the stablecoin references? That's the really critical next step in this industry. And then the next piece of the puzzle is the degrees to which it is banked and the degrees to which it enjoys proximity to the central bank are the next two big policy questions in my mind.
I think we have time for maybe 2 or 3 more questions. Oh, was that? Yeah, please.
Would you like to choose someone?
Well, 2 hands at the back would be great.
A short question. My name is Amnon Samid. Do you think people will be willing to pay a fee for having private, anonymous transactions with private money? 1%, 0.5%, 2%?
I mean, so anonymous is an interesting word.
Up to some threshold,
yeah.
I mean.
Yeah, I mean, anonymous was thrown around a little bit, here as well, which is, I mean, cash is anonymous, but cash has also got like very, very strict limits. At least for most developed economies, what you can do with cash is pretty much limited in terms, even going in and out of the bank. So anonymity is a pretty limited good. And if someone wants to pay a bunch of money for a large anonymous transaction, I'm really not sure that that's something we should be encouraging anyway. So I think, from my point of view,
small amount of money. I want to buy
the one thing,
to
the one
buy
thing
flowers
I would
to buy mistress. I want to do it.
The one thing I would say, I agree with Umar entirely that if you need to spend a lot of money buying anonymity, we ought to do some other checks on you. But the one thing I would say, is the air gap between the central bank, the banking system, your wallet, and how you spend your money is a feature, not a bug. And we ought to really preserve that. And I think most of the Western world and the democratic world CBDC conversation has actually not been hung up by the technology debate. It's been hung up on the societal presumption of privacy debate. And therein, I think we have some really critical boundaries to continue discussing. Just because I nearly launched a project with a white paper doesn't mean that every central bank in the world has to compete with their high street banks and how you spend your money. I think those boundaries really do matter.
Okay.
So lady at the back, and then afterwards the gentleman in the blue suit. Far corner.
All the way over there.
Yeah.
Throw the mic.
Yeah.
Thank you. Dante, now I remember where you were. Appreciate the reminder. I'm Melissa Coity, and I wanted to follow up on the financial inclusion question and also your response to it. Globally, right, a little less than 2 billion people can't be identified. And that sort of front end, are you who you say you are, is a tremendous challenge. You were then referencing, I think, additional data that can be used and brought to bear for KYC purposes. Yet at the same time, we're having a really big debate about consumer privacy, to your point. Yeah. And in the US, we're seeing this begin to come to a head. What kind of data can be used for not just, an underwriting decision, but also fraud, AML requirements. And I'm curious how you all think about that, both that challenge, the opportunity from an inclusion standpoint, and how do we really engage in a debate and an opportunity for leveraging data so that we can bring more people into the financial system, but yet mindful of so many of these deep privacy expectations. And by the way, I have always thought Facebook's Achilles heel was the fact that they have all the data and the ability to really do identification well. So maybe over drinks we'll talk about that more.
Maybe I'll start, and I won't comment on the Facebook angle. I'll let you do that. But I think on the KYC front, just sticking with the US example, there's people who are riding around bicycles in New York City delivering food, and they cannot have bank accounts, not because they can't afford one, but because they're actually not acknowledged as existing in the US. So I think there's, and that's we're talking about one of the most advanced economies, and I think the issue there is not a technology issue. The issue there is a political issue, a legislative issue, whatever you want to call it. So I think when it comes to financial inclusion, for many parts of the world, these similar issues pop up in terms of legal, where the tech it might not even be anonymity. The person may not want to be anonymous. It's just that, or maybe they want to be anonymous in case someone comes after them. But I'm saying, it's just the issues are very complex. So that's why I think my faith in the tech as being a real leapfrog in terms of inclusion is somewhat mixed when you look at the world the way it exists today.
Yeah, I would just say briefly, realizing we're nearing time, if ever there were a group of stakeholders that could actually advance the conversation to the adjacent issues, assume that CBDCs, deposit tokens, and the good variety of stablecoins all converge, then the next frontier set of questions are actually public policy questions. You could get all the decentralized identity, digital identity, on-chain attestations you want in the entire world, and often the tech proves where status quo falls short. But if the policymakers in the public sector do not accept alternatives as satisfying KYC and all of these stubborn financial crime compliance requirements, they're important, but they're stubborn, then we will continue living in a world where so many billions of people will be relegated to the financial shadows. And so I think the tech can show what's possible, but unless the tech plus public policy, I don't want anybody to get agoraphobia in the room. So as these efforts from the BIS are announced, I would encourage a bigger tent and a wider tent that includes non-bank actors as well, because it's an opportunity to show the art of the possible.
Great. So unfortunately, we do have to wrap it up there. If you had a burning question, didn't get to ask it, I hope you'll continue the conversation outside. Otherwise, please give a warm round of applause to the two panelists today.
Thank you, everyone, for this fascinating discussion. Let us now turn to another BIS Innovation Hub project showcase. For this, I invite Ms. Francesca Hopwood-Road, head of the BIS Innovation Hub London Centre, to present Project Pixtrial on monitoring crypto asset data. Francesca, the floor is yours.
Thank you very much, Kudruta, and a warm welcome to everybody, and of course our colleagues joining us online this afternoon. I am delighted to have the opportunity to update you on Project Pixtrial, a project from the London Centre. We have just had the introduction of introductions, but let me also add our view. New financial instruments like stablecoins will require new approaches to supervision to mitigate potential risks to financial stability. Pixtrial is a new tool that helps supervisors monitor the balance sheets of asset-backed stablecoins to see how closely they maintain a stable value relative to their pegs. In doing so, it provides a blueprint for how future supervisory technology could work. Stablecoins are privately issued digital assets that are pegged to other, mainly traditional financial assets such as cash. They are the point at which crypto assets and traditional finance meet. Stablecoins are relatively new, so approaches to regulating and supervising them are still being developed. This creates an opportunity to develop new supervisory technology at an early stage of the regulatory process. Stablecoin balance sheet data is mostly reported monthly, but modern technology allows data transmission that is much more frequent. Information about stablecoin liabilities is available on public blockchains that could be monitored in near real time. But off-chain assets are currently reported less frequently. Infrequent reporting can lead to late identification of risk, and the use of manual submissions is another factor, decreasing supervisory efficiency. Pixtrill provides a tool that will enable supervisors to automatically monitor balance sheets of stablecoin issuers. It will provide supervisors with more frequent and automated reports from stablecoin providers, reducing reporting gaps and enhancing the efficiency and responsiveness of supervision. Pixtrill was developed using a design thinking process. We sought the input of supervisors, as they will obviously be the end users of this tool, and the core project team involved specialists from the BIS Innovation Hub and the Bank of England. Additionally, we engaged with many other subtech specialists from multiple institutions, and I'm delighted to see so many of you in the audience today. So what did we build? Here is a schema focused on data flows and technology. Other than Azure, we developed the project using open source technology. Code is written in Python, and we use a PostgreSQL database. The dashboard is also written in Python to facilitate moving software across entities and to allow for customization. On this slide, you can see the technical details outlining implementation of the business logic that we saw on slide 1. Data flows from left to right, being collected via APIs and then transformed and stored in a database to be used by supervisors. Detailed reporting guidelines for stablecoin issuers are being developed in parallel with Pixtrill's development. We have been designing Pixtrill from first principles, as stablecoin regulations are still evolving. This means that we did not necessarily have a clear view of what a data model would eventually look like or be required. But it is clear that data models used to supervise stablecoins need to be flexible, as the business models, underlying assets, and nature of liabilities tend to change. We've been making informed decisions about what this model should therefore look like. To do this, we use publicly available guidance, discussions with our supervisory community, and existing supervisory data templates to frame the data model. And the data model reflects several aspects of the stablecoin business architecture. At its most basic level, Pixtrill looks at assets and liabilities, their characteristics and their relationships. In addition, we prepared the data model for other potential stablecoin issuer risks that supervisors might want to capture. For example, issuance and redemption mechanisms. In addition to the blockchain data captured in the model, most of this information is off-chain, and some can be quite static, for example, stablecoin issuer information. We believe that this data model and the storage schema connected to it could be a valuable starting point for the supervisory community when they're considering how to monitor similar digital assets, if and when they come within the regulatory perimeter. Once the data model was established and was developed, building the databases and APIs that you can see on this slide was the next step. We tested both pushing and pulling balance sheet information, as this provides supervisors with a complete view and fits with their current appetite. For instance, supervisors that we heard still want to have reports sent to them, but they also want the option to directly access some additional information. Pixtrill crucially tests both approaches, and it tests how both push and pull can be combined. For instance, stablecoin liabilities can be obtained from stablecoin issuers using submitted data, the push, but it also might be validated or enriched by pulling data from blockchain networks in near real time. Once the data is collected, it can be displayed for supervisors to explore. On this slide, you can see what the Pixtrill dashboard looks like now. It's still in development. It enables users to scrutinize the quality of collected data and then quickly gather supervisory insights about stablecoins. Interactive charts show, among other things, information about detailed asset compositions, holdings of individual issuers, details about issued tokens, and blockchain networks. They allow filtering by individual stablecoin, blockchain, or token. This dashboard provides supervisors with detailed information about stablecoins that was collected from the issuers or public blockchains. Pixtrill is a proof of concept that aims to show how data models, data flows, and data storage can be combined to generate dashboards that can be used to monitor stablecoins for balance sheet risks. With Pixdual, we're exploring the role new technologies can play in the supervision and risk management of new financial instruments. But also Pixdual shows what a future approach to supervisory technology could look like. It employs design thinking to ensure that the needs of its end user, the supervisor, is baked into its features at the outset. It's modular. Its components, including the data model that I've talked to you about, the API, the data storage solutions, and that crucial supervisory-facing dashboard, can be configured according to the specific jurisdictional or institutional needs. It can be used in its entirety, or it can be used in parts by other organizations. And we're currently testing this usage with another central bank. Pixdual's architecture could also provide a blueprint for how to monitor and supervise other digital assets. And finally, Pixdual provides a way for a regulatory future where supervisors provide data requirements and data transport layers, for example, using API specifications, to regulated firms to receive clear automated reports in return. We're coming to the end stages of Project Pixdual in London, and please do get in touch with me or my colleagues in the London Centre if you are interested in finding out more and helping us to continue to shape out the future development of Pixdual. Thank you very much.
Thank you, Francesca. We are now moving to a conversation on tokenization and smart contracts. Please join me in welcoming Mr. Per Vonzelovic, head of the New York Innovation Center at the Federal Reserve Bank of New York, to moderate the session.
Good afternoon. I'm Per Vonzelowitz, the director of the New York Innovation Center at the New York Fed, and welcome to the fireside chat on tokenization and smart contracts. We've really benefited from some fantastic discussion throughout the morning on similar topics, and we're focusing during this fireside chat on trying to get a bit deeper into some specifics around examples where tokenization and smart contracts might be delivering value, or where there's still opportunity for these new technologies and new instruments to deliver value. Tokenization is the process of representing claims digitally on a programmable platform, but programmed with what? Programmed with smart contracts, which are self-executing applications that can trigger an action if a condition is met. Tokenization is a rapidly developing field. There's been a lot of experimentation in the private sector and across the BIS Innovation Hub and the New York Innovation Center in three broad areas: foreign exchange, securities, and tokenized deposits. Now, we've heard quite a bit about the unified ledger concept and also Project Agora during the day. Those are two practical examples of experimentation in this domain. We just heard about tokenized deposits and stablecoins from Umar and Dante in the previous session. And in this session, we'll focus more on financial markets and settlement. Now, throughout all the experimentation, there have been quite a few learnings that have been generated so far, a lot of data. And in general, the experiments indicate that tokenization is feasible and has potential. But where is the potential specifically? And how do we best collaborate to realize this potential? To collaborate, there are roles for central banks, commercial banks, non-bank financial institutions, and financial infrastructure and technology providers. On this panel, we're very fortunate to have representatives from a commercial bank and a technology firm, as well as a lot of central bankers in the room to provide another perspective. First, we will explore where innovation is generating progress, and then focus on how we can collaborate to continue the progress. So I'm delighted to introduce Stella Lim, who is the COO of Partior. And apart from leading Partior's global partnerships and operations, she oversees a wide range of critical functions, including business development, customer onboarding, government affairs, and communications and marketing. Prior to joining Partior, Stella was with Swift for 14 years, most recently as the managing director for Swift in the Asia-Pacific region. Prior to her role at Swift, Stella held senior positions in information technology and banking, including roles at organizations such as SmartStream Technologies, Internet Security Systems, Nettic.com, and Deloitte. I'm also delighted to welcome Xiaonan Zhu, Head of Innovation and Digital Assets at UBS. Xiaonan is the Head of Innovation and Digital Assets at UBS Group Treasury, where she drives digital asset strategy and leads the institutional adoption of digital assets globally. Her deliveries have spread across capital markets, treasury and transaction banking within the fields of CBDC, digital bond issuance, digital cash, and digital collateral trading. Xiaonan represents UBS in fintech, digital assets, and CBDC collaborations with central banks, fintech companies, peer banks, custodians, and exchanges, and she is also on the board of the Corda Blockchain Network Foundation. And now to get into the questions and the discussion. When we talk about potential for these technologies, this really has two sides to discuss. First, what the technology can do. Practically, what is the potential of the technology? And are there characteristics of this technology that are advantageous relative to the current state and legacy technologies? And second, where are the opportunities to improve how we do things today, and what are the challenges? Is it especially suitable for particular use cases or in general? We already heard a lot about tokenized private money, so going a bit wider, what are the unique technical characteristics of tokenization that could benefit financial markets and settlement? In which markets or asset classes might tokenization deliver the most significant value proposition? Why? And what do we miss if we do not have tokenized assets? So I'll start with Stella. In which areas beyond money that was already discussed in the previous session do you see the technology having the most potential benefits and why? Can you please provide some specific examples?
Yeah, thanks, Per. First of all, it's a real pleasure to be here. I think there's no doubt that we have heard the whole day the conversations and also by various different central banks and countries, and also in the previous sessions on technology benefits that it can bring to tokenizations. So when you go deep down into it, there are a lot of characteristics in tokenizations where it's programmed by smart contracts. So in smart contracts where you see the programmability, immutability, composability, atomic settlements that is making all this process happen. In the current traditional world where you have the transactions that is being facilitated by multiple intermediaries and institutions across messaging separately, clearing and settlements, hence a whole delay in the process itself. So with the technology that has empowered the whole process end-to-end in one venue, it makes everything possible in terms of access into the liquidity itself. So traditionally, like the illiquid assets that is impossible, allows the investors to be able to get access to it in various different markets. It's a lot easier. So this helped a lot in assessing the business case of liquidity. So in Boston Consulting study, it has shows that the opportunity for real-world tokenizations will grow to 65 trillion by 2030. So this is a real benefits to the world looking into how financial services coming up with new different products to be offered to the markets, and also in terms of revenue generations for them. Another area to look at where technology has empowered is really a lot we talk about incorporates into smart contracts, the regulations, the rules, the compliance has made the whole process that it eliminates some of the admin process. But of course, in the earlier previous sessions, a lot has to be overcome in terms of challenges. How can this be monitored? How can this be mitigated in terms of the risk itself? So from there, you also need a really trusted market infrastructure to play the role with technology that can it will be interoperable. Because we spoke about unified ledger. It may be multiple unified ledger because each unified ledger carries its own different assets and purpose. And how do we interoperable with all these unified ledger together? whether via API, it has to be an open standards and protocol where all the various different projects, we heard about BIS as now various different projects in many different countries. How do we get these different projects together? I believe that banks are all very, if I may be honest and open and direct, fatigued in all these POC and projects. It's a lot of budget resources to put into, but how can each project be able to be reusable? Reusable, and also it comes out from the project to graduate from sandbox and continue to commercialize and be able to use with it. So all this has to be powered by a roadmap of technology planning. Plus, institutions has different area of expertise. Some has better in terms of resources and budget to put into internal R&D center, but some will be relying on government support, central banks, in terms of public and private sector to come together to cooperate and coordinate together. So as we emerge from the smart contract become a revolutionary technology, I think it's a lot also about the receptive of banks on how they can deploy the technology, internal risk policy, the appetite, how can they implement the technology to be a longer run.
Thank you, Stella. And now on to you, Xiaonan. When you think about the potential of tokenization and smart contracts, what are some of the frictions that exist today that tokenization and smart contracts could potentially solve for? And could you talk a little bit about the potential benefits?
Yes, certainly. And firstly, thanks very much for having me here. When it comes to the tokenization, there's a lot of benefits this technology can bring us. We know that the financial market today is making up with a fragmentation landscape of custodians as well as counterparty relationships. As a result, when we move in securities as well as the collaterals across the globe, it is actually very expensive and it is actually prone to the settlement risk. On top of the fragmentation of the financial market, we also have the situation that when we're trying to settle a transaction, the security movement and the cash movement might not happen at the same time. So this fact that things are not happening simultaneously, creating the further risk and the further hurdles for us. This means that for large financial institutions, for example, we will have to put excessive buffers to make sure that we can have better certainty to settle a transaction. Sometimes we even have to put buffer on top of buffer to make us feel better. So it is really a good way to actually utilize very scarce financial resources and high quality liquid assets on our balance sheet. I don't think it's really a good deal. So what can we do? Here comes the tokenization. Tokenization promises us the simultaneous settlement of securities and cash. It also allows us to use a shared ledger to see everything at the same time across all the parties, across the transaction. So this really provides an opportunity to actually making things more synchronized. Using one example, actually back in 2019, we have already tokenized and executed a collateral swap with the help of a fintech vendor called HQLAX. So in that transaction, a basket of German government bonds and a basket of corporate bonds were tokenized, and the ownership were represented on the blockchain. The settlement of the security of the transaction is actually by simply updating the record of the ownership on blockchain. So it happens real time at the precise time that we wanted to settle, and there was no settlement risk. But we know that really having more setup like that, we need wider network effects. And this is probably something that will happen during the course of the years. But if I may, just to draw people's attention on something that a lower hanging fruit, I will certainly call everyone to looking into the intercompany transactions, because such transactions do not rely on the network effect. We can simply just using our own entities and infrastructure to adopt this technology and utilize it more widely. A good example I could also give is within our US entities today, we are already working together with our market infrastructure provider, Broadridge in this case. Using the tokenization technology, we were able to trace the collateral movement, and we were able to see in real time where the collateral is. So as a result, we can actually simplify the operating model and reduce the amount of accounts and the time we have to handle such transactions. So those use cases hopefully give us some example to show how the tokenization technology can actually be implemented in the financial world today already.
Thank you. And you both cited some great examples of where value is currently being realized using tokenization and potentially smart contracts, but also where the potential of it is. And one thing that I heard is there might be one way of separating the value proposition where there could be value created for internal purposes. So this could be operational value that's realized for an institution, or external value that might be realized by your customers and clients. And I wonder if you could expand a little bit on some of the examples you provided where you're seeing the bulk of the value today. Do you have a point of view on if there's a critical starting point for value creation that will really lead to the greater adoption of these technologies? So will internal lead or will external lead? And how do you see that playing out necessarily in the future? Stella?
Yeah, I believe it's a lot about collaborations because we're talking about network density here. It has to scale. It's not just a few, it's not just for internal, but externally it has to come together in terms of cross collaborations. So it cannot work in silo. Silo can only be very domestic into the applications itself. So when it comes to collaborations, a lot of parties that come together where we, and in this room, the central banks, the financial institutions, the market infrastructure provider, and technology vendors like Patio, where everyone's come together to look into how can we scale the projects itself. And beside from technology perspective, there are a lot of discussions around the legal framework, around the regulatory framework, around the private sector's coordinations. How do we scale the projects itself to eventually have end visions? What do we want to do with it? Is it commercialize a project, or is that just research and testing? What do we want to do? I think with that, it will give a clear visions for each institution to make a decisions on how to budget the projects, to plan for the future roadmap into that perspective. So there are many considerations, and also geographically, each market has different maturity. So markets that are more prone to the digital transactions will have a better and quicker uptake of tokenizations. So this would actually benefit the markets of developed countries versus the developing markets that is being very cautious in terms of approach into looking into that.
Thank you. And just down on, if you have a brief follow-up on the prior question, just relative to where you're seeing the value internally or externally before we move on to the next question.
Yeah, certainly. I think it's very critical because the tokenization is a long journey and it's a marathon. We all coming together and try to break the silos and break fragmentation through Agora, through unified ledger, etc. But before we come into the end of the game and the perfect best future, we really need to think about how do we face ourselves and so we do not just lose the momentum. And how to do that? We can do this by starting from early and low-hanging fruit use case, like the one that I've just mentioned, because by doing such use case, we were able to quantify the liquidity saving by seeing how much high-quality liquid assets we freed up. We can monetize it for something else. We were able to, for example, quantify the hours of the labor cost from our back office and middle office. So all of those will package into a use case to persuade our senior management and the shareholders that this innovation journey is something that can not only bring us to the perfect future, but also bring us some medium to long-term benefits. It's not something that we will have to wait and a big risk we have to take, because no one wants to just take a risk and with just one word, okay, it might come in 10 years' time. We really need to see small things happening step by step, and that's why we think the collaboration internally, but also connectively with the network is very critical.
That's great, and I love the example of quantifying the problem and also quantifying the actual value that the solution has delivered. And it seems like we're at a critical juncture with a lot of these technologies, again, where there's been a huge amount of research and tremendous learnings from that research, but we're now focusing on the practical benefits and how do we really realize those benefits for whether it's internal or external use. And now we'll move on to the next question, and Stella, you started to touch on this earlier a bit, and a major challenge in technology adoption for banks and payment or settlement has been to generate some form of network effect. So effective change requires widespread coordination to ensure adoption at scale. I'm not sure we're seeing scale yet, but we're seeing adoption at points, and we can evaluate that data and those examples just as you were providing in a really useful way. So how can we as central banks, commercial banks, market infrastructure and tech firms collaborate to ensure this positive change? So I'll start with Xiaonan this time. So when banks are thinking about strategic technology investments, is tokenization really on the list? Where is it on the list? Is it at the top or somewhere else? And could you provide some more practical examples of effective collaboration driving adoption?
Yeah, certainly. So the innovation and the technology is very important for large financial institutions, or in this case for UBS as well. We not only have strategic investment into tokenization and other use cases and technologies, we also have the warm body on the ground, like myself and the team, to actually execute and deliver such vision. So when it comes to the collaboration, I think it is really a paramount, especially at this stage when tokenization is at the infancy. Why do I say that? Because the collaboration creates the common standard, the common rulebook, and that's make sure that when we create the different digital assets on different platforms, they will have the good liquidity, and the liquidity matters to everything. So this is really the guiding principle for a lot of things that we are experimenting today from the UBS Treasury digital assets perspective. An example of collaboration I can give you is back in 2022, when we were looking at the UBS digital bond experiment, we were thinking, okay, at that point of time, we have seen so many digital bonds launched. However, they were all merely private placement because they are launched on platforms that are only connected to itself, available to its own member banks. So we collaborated then with our fintech partner SDX in that case, and we encouraged them to work together with the traditional market infrastructure provider. So that yielded a great collaboration between the SDX and the Swiss exchange, SIX, and that created an operational bridge to allow UBS digital issuance, which was a 375 million OPCO bond, to be floating across both digital and traditional platform. So the bond is as liquid as a traditional bond and also acceptable for all the investors that who normally trade UBS bonds. So that is an example to show that collaboration within the private sector. You have a bank, you have a fintech, and you also have a market infrastructure provider. And then if we extend that example, we already heard earlier, Mr. Jordan mentioned Project Helvetia Phase 3, so that is also a perfect example to show when the central banks come into this collaboration with us, we can create a perfect settlement asset for a digital bond in a digital format. And this is really something that we all want to see one day. And maybe just to conclude with another more visionary case or example here. When we think about tokenization, we shouldn't just think about using tokenization for the short-term efficiency gain or cost saving. Obviously, that is very important, but how about more important things to the heart of our central bankers and regulators, and also ourselves? For example, the financial stability, the market resilience. We know that in the US, we are seeing the central clearing of US Treasury securities coming in the next couple of years. And one big reason that the regulator bringing this up is because we want to see less settlement risk in this most important market in the world. So the solution is a central clearing, but we also know that, okay, they did tokenization, promise the same thing, i.e. they remove or reduce the clearing process and also making things more synchronized. So we've already showed ourselves that the UBS example, when we launched the digital bond, there was no clearing process, there was no trade matching process, because a digital bond natively issued on a blockchain by nature does not require matching, does not require bilateral clearing. So yes, we're using a different technology, but we are moving toward the same direction where the US regulators wanted to see for the treasury market. So to conclude, I think the journey, again, is a marathon, and the best network effects need the collaboration across the central banks, the regulators, and the private sectors.
Thank you. That's a fantastic example. And I love the example of Helvetia, where it seems like it's a great use case of a progression from research now to something that's practical, and also a great example of collaboration between the public and private sector. And now, Stella, the same question for you. You're coming at this from a different perspective, from the perspective of a technology provider. So what role do you see for technology partners in driving collaboration?
Yeah, I think to echo what Xiaonan has mentioned earlier, a lot of initiatives that she has just mentioned is also in partnership with technology providers and partners. So this is the role where Partio is playing. Large institutions is probably able and affordable to build R&D team internally, or to work with technology partners like Partio, where we are blockchain powered market infrastructures to do cross-border clearing settlements and also PVP and DVPs in the roadmap itself. So when you come into the markets where you have various parties in the projects itself, central banks, the private institutions, and also market infrastructure, this is where technology partners can come in with live platforms and to power the projects itself rather than building from scratch. Because if you build from scratch, it's a lot of effort to go into starting the projects. All they need to do is leverage on the platform. What they have to do is then incorporate into all the other business considerations, legal, government support. It is more about coming back to collaborations to make the use case more scalable, and more participants of various different sizes and different markets is able to participate in an open protocol and standards itself. So I see this is where the technology partners in the markets can provide the benefits too.
Wonderful, thank you. And certainly from the perspective of the work that we've done in the New York Innovation Center, collaboration has been a key success factor for our work. We're delighted to be one of the collaborators on Project Agora as well. And now we have a little bit of time to open up for audience questions. So there's some microphones. So if you have questions, please raise your hand. And when you take the mic, please introduce yourself. So let us know who you are and then ask your question.
Hi there, can you hear me? Okay. Hi, this is Catherine Gu from Visa. Nice to meet you guys. I do want to go back to the debate between the public versus private chains, because increasingly what we're seeing is that the tokenization on the asset side is much more pro to going for the public chains, as we've seen with BlackRock, right, recently. But I think on the tokenization of deposits and tokenization of money in general, given different type of regulations, that remains to be more on the permission side. So I think this probably suggests a new type of fragmentation that could emerge with your assets versus your liquidity on different type of network. Do you think that will be an issue, especially I think you did touch on the atomicity of all these exchanges. Do you think that could create a new type of friction as we're looking to how, can do finality and settlement in real time? Thanks.
Yeah, I can quickly pick this up. So I think it's extremely important to understand the technology setup and interoperability in this case. And that's why we have been working for a very long time with technology providers as well as the market infrastructure provider. I think in the end, it's not just a technology setup, as previous panel have said as well. It is a legal setup, it's also a regulatory, and sometimes could be a geopolitics reason as well. Swiss National Bank, again, is quite pioneering in developing the pillars of central bank digital currency. And why I keep mentioning that, because for UBS, when we're looking at the central bank digital currency or digital money perspective, we don't just looking at, okay, one single protocol or one single setup. The project Helvetia actually allowed us to see that how a digital liquidity of central bank money with a traditional commercial bank money or traditional RTGS money can work together. Coming from the treasury myself, I know that the intraday liquidity or liquidity is paramount. So how can we actually see the different liquidity across different boxes and across different protocols coming together, and to really manage them and create the transparency and the traceability is really crucial here. And when it's come back to the public and the private debate, I think this debate will exist forever, and the different people will have different preferences. But I think in the end, as a bank, our mission is to create the stability and to create the value for our clients. So that means we create the best product for our clients as well. So again, back to the example about UBS Digital Bond, we issued on a Corda blockchain powered by the SDX platform. The reason for the first bond, obviously, is very simple, that SDX is FINMA regulated. But apart from that, we also depends on the use case, because a UBS digital bond is not some, it's not like a public investment that people will wake up tomorrow morning and say, why don't we buy a UBS digital bond? So because with the digital bond issued by a large institution has very targeted audience and professional investor. So back to the question again, when we look at the public or private, a different setup of technology, we need to be use case driven and commercial viability driven.
How do you see it from your operation role in UBS, the coexistence of CBDCs and tokenized deposits? Is this a big thing or something that will evolve in parallel over time, or do you see one over the other privileged?
It's a great question. I think firstly, I think we're touching the two different types of money. Regardless, it is a blockchain-powered or not blockchain-powered, central bank money is always the trust anchor of the monetary system. Today, we already have UBS money or commercial bank money, which is your deposit at UBS. So this means that when we're looking at the future of the money landscape, it is very important for us to observe and to explore how we can utilize the same technology to bring the liability of UBS onto the blockchain, and most importantly, to make it interoperable with central bank money. That means that if in the transaction banking or correspondent banking field, our money, if we were to utilize the blockchain, needs to be able to transferable with the digital coin or digital money issued by, for example, JP Morgan or Citigroup. But at the same time, the settlement of the large banks still needs the trust anchor money, which is the central bank money. So as a result, no matter it is a Swissy or it is the US dollar, the central bank money coming into the scope will really bring the whole ecosystem into a more regulated and more trusted stage.
Thank you. My name is Usman Mandeng with Accenture. Hello. I would like to ask, coming back to the interoperability, because my sense is that a lot is being talked about interoperability, but to me, it's a little bit like a red herring. There is the possibility that we have various different chains, and of course we have various different systems. Today there is no interoperability between systems. They all operate in complete isolation, and the only way they communicate is via secure messages. There is no reason to believe that we couldn't replicate that for the blockchain world if we wanted to. But is interoperability really a problem? I mean, I can see in the future that, say, a bank like UBS is issuing on Solana, it's issuing on Ethereum, it's issuing on various chains. As long as these coins can flow back and forth, there is no reason why interoperability is actually a challenge in the first place. Could you comment on that, please?
Do you want? You can, yeah. I think, I believe interoperability is a very big topic itself. It's a very big topic because you wanted to make sure that the projects that you're implementing, like you just mentioned, on a different platform and also on-chain, off-chain, on the transactions itself, you wanted to make sure that they're synchronized. And if it is a financial institution that is operating, especially when they have a global footprint across various different markets, the interoperable of the transactions itself in various different markets has become very critical in order to make sure that the transactions can flow through and also be able to survive the different time zones and also the trading windows itself. As you cut across from US all the way to Japan markets, the trading windows has become like smaller and smaller. And then you have all these settlements times that has been changed from T+2, T+1, and eventually the end vision of T+0. So it has become very important in terms of open standards. Right now, you're right, it's operate at a very silo environment, and some of the institutions or even like technology vendor are looking into providing the various different API, a standard API and global APIs that is able to link some of it together, not all entirely. It's still a long way, it's a road to go.
Yeah, I can only echo that. I think in today's transaction banking landscape, there's a different complexity. The reason a lot of large banks exist today is because we're providing this facility to allow that banks or small institutions that do not have the connectivity today to be able to make transaction. And such activity or such services is still prone to delays and prone to risk, and also is very costly, especially for the smaller players in a smaller jurisdiction. So that means that interoperability one day, if can be created, could potentially mean less intermediaries and less large banks in the middle. Probably in today's world, when you have 10 intermediaries in the middle to make a transaction, in the future, if you have a better interoperability, you may only have 5. This immediately already reduced your cost and reduced the time that's to settle a transaction. So I think the interoperability matters a lot. It's not only a technology thing, it's also a business model where someone will need to give away some interest and someone will need to hurry up with their technology development.
I'd like to ask a follow-on question to that, where we heard earlier about the potential to enhance financial inclusion. And we've also heard some examples from larger financial institutions around the world that are benefiting from these technologies, investing in these technologies as well. And I wonder if you have a point of view on if tokenization is a benefit or a value proposition that's equally distributed across larger and smaller institutions, or equally distributed across geographies, or if there's really a different potential for these different types of institutions based on size or based on geography. And Stella, perhaps we could start with you.
I think the word's equal. It may not be equal in terms of the institution size. So the larger institutions will tend to have a better technology in terms of support their tokenization's journey within the organizations itself because of the global footprint that they are covering in multiple different markets. In terms of their revenue generations, the products that they can offer to the markets, where they can offer to their counterparty, there's smaller institutions, their entities, they can have better access into the markets itself. So the smaller institutions will then get indirect or direct benefits from the larger institution in terms of partnership because tokenizations is a win-win partnership between the larger organizations and also the smaller organizations itself. However, in order to balance between the larger and smaller institutions, I think interoperable technology is very important to bring both of them together, because the journey, the maturity of both organizations will be very different. So I think the struggle that the smaller institution or even some large institutions to deploy a new technology is very much because of the complexity to integrate into the current legacy systems. So this is where all the spaghetti and spider nets has come in, and how they can further improve to turn into 24/7. We talk about real-time, instantaneous and simultaneous settlements. It's 24/7, but it's not just technology. Are banks ready for 24/7 operations? So are they ready to support the different markets? Technology is there for them.
So yeah, I would quickly add on that. I think when it comes to the smaller organizations compared with the large ones, sometimes I feel really jealous of them as well, the smaller ones, because they're more nimble. They can quickly adapt some new technologies, maybe faster than large organizations. Again, I think when it comes to innovation, I don't think it's size-driven. I think, again, it's use case-driven and business model-driven. The smaller organization would have a different use case than us. And don't forget, it's not necessarily very expensive to start innovation, because a lot of the fintech solutions actually not very expensive to start with. So as a smaller organization, it is always encouraged to directly working with those most innovative fintech companies and create their own roadmap. I think that is a great way to show that the financial inclusion can start from the stage that when the smaller institutions can bring the innovation into their own hand and create more value and economic benefit to themselves and to their clients.
Thank you. I think we have time for one last question, if it's a quick one. Just over there.
Thank you. I wonder, what are your thoughts in terms of climate aspects of asset tokenization? Let's say you tokenize a green bond, right? And you issue that end-to-end on-chain. What's the carbon footprint? And what's the requirement to the climate-related disclosure and to ISSB standard? Thank you.
Yeah, I think we actually have our colleagues from the HKMA who are probably better positioned to answer the green bond issuance, because they have been doing great experiments in that space. But from the investor or the trading perspective, I think tokenization, digital bonds, is still at the infancy, let alone like a tokenized green bond. So it's required a lot of research into this space, and also a lot of data to be collected to really prove the trade-off of the efficiency is created versus the carbon footprint is created. So I have to say, I don't have a definitive answer for you now, but hopefully next year when we come back to the BIS Innovation Summit, we will give you a dashboard.
Well, thank you for the insightful questions and the fantastic discussion. So please join me in thanking Xiaonan and Stella. And please do join us afterwards for drinks and continuing the conversation.
Thank you, everyone. It is now time to showcase the most recent BIS Innovation Hub project on tokenization. Let me welcome Mr. Morten Bech, head of the BIS Innovation Hub Swiss Center, to present Project Agora. Morten, the floor is yours.
Thank you. Good afternoon. It's my pleasure to give you a quick overview of Project Agora. It's very early days, but I hope you will find it interesting. It's not going to be a secret to you by now that it looks at applying a unified ledger to improve cross-border payments. So one of the most difficult tasks of a BIS Innovation Hub project is to come up with a name. It has to reflect something of importance and hopefully also something that is relevant to the project scope. We failed forward many times. Agora is Greek for marketplace, and as Joachim Nagel mentioned, we think it captures well our idea of bringing together different perspectives to come up with a common solution. Also, earlier you might have heard Hyun mention that we will be using AI in this project. And I don't think this satisfies his requirement, but this picture was actually generated using AI. We asked for a Renaissance painting of an ancient Greek marketplace. And I should say that the accent is important over the last A. Why? Because there's actually a whole lot of Project Agoras out there. And so this is just one example. It's a music festival that actually took place here in Basel this weekend. And maybe next time we need to coordinate better. But you all missed interesting sessions such as Disco for the People. Back to reality, Agora. So it builds on the unified ledger vision that was presented in the BIS annual economic report of last year. And the idea is really to put tokenized version of commercial bank money, central bank money, and digital assets onto the same platform. And I think the hope is that this new type of financial market infrastructure will both improve the old and enable the new. And so the BIS Innovation Hub has started to work on projects that will test the feasibility of this vision. And the first use case, as we'll discuss today, is really cross-border payments. So cross-border payments are known to be, they can be slow, expensive, and opaque, and correspondent banks have been retreating from cross-border payment business. So while value and volumes has actually been increasing, the number of active correspondents and even corridors have both been falling. And this decline, as you can see, has been global across most all regions of the world. And the worst affected parts are the areas such as parts of Africa, Latin America, the Pacific, and Eastern Europe. And so fewer active correspondent banks and corridors obviously introduce frictions and increases cost and impedes overall access. And the idea of Project Agora is really to try and see if a unified ledger approach can do things better. As most of you might already know, the current flow of cross-border payments are sequential with multiple steps along the way where they are between the payer bank and to the payee bank. And there are many repetitive formatting, balance, and regulatory checks along the way. So this illustrates the happy path. This is the not so happy path. So if there's any issues along the way, at any point, the previous steps in the chains might need to be rolled back, and this can introduce costly delays, and mostly due to the need to manually fixing errors and the cumbersome reconciliation processes that happens. And so in principle, we might need to go all the way back to the payer. And so what Project Agora is trying to do is really to turn this on its head. And how? So very much like we saw in Project Mandala, the idea is to see if we can do some of all these checks up front and in a collective fashion. And then once you have all these checks, hopefully then you can settle all the payments and all the payment steps that needs to be done in one go. The idea is really that with both central bank money and commercial bank money in tokenized form on this unified ledger, you can do this in a synchronized step using smart contracts in something that is called atomic settlement. So the unified ledger is really, as I think about it, a thin settlement layer that has both commercial and central bank money on them, and upon which the private sector can build new and innovative solutions. A lot of people have asked me what is the difference between Agora and the BIS Innovation Hub's other tokenization projects. And I won't go into this in any great detail. This is my weird mental map of how the tokenization space looks. But as you can see, that most of the projects that the BIS Innovation Hub has been involved in has not surprisingly looked at tokenized central bank money. And then we've looked at two use cases that are different. One is like settling tokenized securities, and the other one, as was shown earlier with mBridge, looked at cross-border payments, and Helvetia and Syra was obviously examples of settling tokenized security. So what is new with Agora? I think it's really this thing that tokenized deposits are going to play a much larger role in the settlement of cross-border payments, right? So just as done by an mBridge, Agora is going to look at cross-border payments. But importantly, there's a lot of simplifications that we're going to do. For example, in Mariana, we took a deep dive into foreign exchange market in the future tokenized world. We're not going to do that in Agora. There's going to be no FX module or anything like that. We'll leave that just as it is for banks today. And tokenized deposits, of course, I should mention this, is going to play the same role that traditional deposits play today in cross-border payments. Also, we're going to take central bank access policies as given. Some of the other projects that we've done, for example, Shura and Dunbar, non-resident financial institutions were assumed to have access to the CBDC or wholesale CBDC of a foreign central bank. And so that solves a lot of problems, but we're not going to assume that in Project Agora. So what is it that we're trying to build? Well, we're trying to build a prototype of this Agora financial market infrastructure. And we'll put, as we mentioned several times, both wholesale central bank monies on there and the tokenized deposits, or if you will, deposit tokens. And we have seven central banks lined up to join us in this effort. And who are the 7 central banks? In the BIS, we have this notion of the 5 international currencies, and then, so that's the dollar, the pound, the Swiss francs, the euro, and the Japanese yen. And then in addition, we also have the Korean won and the Mexican peso. And I think that gives us a global reach and a bit of diversity also in terms of needs and types of cross-border payments. So what will we actually do? So it's a public-private collaboration it's a public-private collaboration. And I think the key achievement is really that we managed to get the 7 central banks to agree to sit down around the table and try and scope out solutions together with the private sector. So the BIS will be the convener of the public sector, the central banks, and the Institute of International Finance will convene the private sector from the 7 jurisdictions. How will we organize this? Well, so the BIS and the IIF will kind of will determine the, overall strategic scope. And then there will be this Project Agora committee where every participant has 1 member. And they will provide tactical guidance and make decisions as needed. But the work itself will be split across 4 work streams: business, technology, legal, and comms. So really, the business and tech work streams will define the requirements for the prototype and devise the testing. The prototype itself will be built by technology vendors. And then the legal work stream, I think, is very important because that will actually, across each of the 7 jurisdictions, try and do a legal assessment of the nature or how tokenized deposits work in each jurisdiction, and also together with wholesale central bank digital currency. And then the legal workstream will also see how these will interact across jurisdictions. And then the comms workstream will, of course, be in charge of external communication, and that particular one will be led by the BIS. All right, in my 12 seconds left, I will tell you when the private sector can apply. So the call for participation, which we will announce, opens on May 14. And so we look very much forward to you all applying, and then hopefully we'll meet again at some point. Thank you.
Thank you, Morten. Too bad we missed the Agora Festival, but looking forward to the public-private Agora party. Our last session for today is about designing a legal framework for unified ledgers. Please join me in welcoming Mr. Ross Leckow, Deputy Head of the BIS Innovation Hub, to moderate this discussion.
Thank you. Thank you, Kudrytsa. You know, it's always a little bit disconcerting when my name is announced and people start leaving the room like this. But I'm going to assume it's the time of day rather than my presence. But it's my great pleasure to welcome you to the final session today on designing a legal framework for unified ledgers. We've had some fascinating discussions so far in this conference on the potential for tokenization to really shape the financial system of tomorrow. And all of this is relevant for the vision of unified ledgers and the Finternet laid out by Augustin Carstens in his opening remarks. The unified ledgers concept envisages a world in which tokenized central bank money, tokenized commercial bank deposits, and other types of tokenized assets would coexist on the same platform or platforms in a way that would enable programmability, composability, and automation. As my colleague Morten Beck has just explained, our new project, Agora, I hope I pronounced that correctly, explores some of the key features of the potential for unified ledgers. Two key projects in the United States and South Korea, respectively, have explored or are exploring some elements of the vision laid out by Augustin Carstens this morning. In the US, our friends at the New York Innovation Center, in collaboration with members of the US financial services industry, have participated in a proof of concept that experimented with the idea of a regulated liability network, or RLN. And the RLN concept envisages theoretical payment infrastructure designed to support the exchange and settlement of digital representations of central bank money and commercial bank deposit tokens using distributed ledger technology. And in Korea, the Bank of Korea has announced a joint project with the Korean regulators under which wholesale CBDC issued by the central bank will coexist on the same platform with tokenized commercial bank deposits and CBDC-backed tokenized e-money issued by financial institutions. While there are many different issues that need to be addressed in bringing the unified ledger into reality, one should not underestimate the importance of the legal framework. And indeed, Augustin Carstens in his opening remarks, and many of our panelists today, have stressed the importance of a legal framework to ensure that the unified ledger would actually work. I think, as is the case with almost everything in life, it will only work if the law is there to support it. We're privileged to have with us today two distinguished lawyers who played key roles in the two projects I just described, and who will share with us some of the key legal issues that arose in these projects in a way that will help inform our discussions on the design of a legal framework for unified ledgers. It's my great pleasure to introduce to my immediate left, Ms. Rebecca Simmons, who is a partner in Sullivan and Cromwell's Financial Services and Capital Markets Groups in New York. Rebecca is head of the firm's payments practice and co-head of its fintech practice, and her practice focuses on financial services functions such as payment, clearing and settlement, and the development of new approaches to financial services operations, including the use of new technologies. And Rebecca was the principal author of the 2023 legal report on the regulated liability network proof of concept. To my far left is Dr. Jong-gu Yi, who is a senior partner at Kim & Chang, the largest law firm in Korea. He's a member of the Regulatory Reform Committee of Korea's Financial Services Commission, as well as a member of the Money and Banking Forum within the Bank of Korea, where he advises on central bank digital currencies and digital asset issues. Dr. Yi has a PhD in economics from Stanford University and a JD from Stanford Law School. So Rebecca and JG, welcome. So we have 40 minutes for this session. And what I would like to do is to pose 3 questions to our panelists and give them each the opportunity to respond. And after that, we should have some time left at the end for some questions from the audience. So I'd like to start by asking each of you, starting with you, Rebecca, to briefly describe in somewhat more detail than I just did the principal features of the project that you were involved in, and then perhaps to lay out what you consider to be the key, I guess, most challenging legal issues that would need to be addressed for the model that formed the subject of the project to actually work. So Rebecca.
Well, thank you very much, Ross, for having me and for the kind introduction. I'm actually not sure I was the principal author of the report, but I was the coordinating author of the report. We had a working group of many lawyers, both internal and external, who were major contributors to the report, including my colleagues. So, but I think RLN works in many ways similarly to what Agora would, the ways in which Agora would work. I think our diagram looks similar, but not quite the same. We provide, the project contemplates that you will have a payment between an originator and a beneficiary, as you would today, and then settlement of the resulting liabilities amongst the different banks in the payment chain, as you would today. But those are two sort of separate lines of settlement, but the RLN system would ensure that both of those settlements occur simultaneously by using both central bank tokens and commercial bank tokens for purposes of achieving simultaneous settlement of all the steps in the transaction at both levels of the payment, or none of them at all. So it either all happens or none of it happens. I think we did use deposit tokens, or we refer to deposit tokens in a wholesale CBDC in the report, but I think one might argue that the tokens were not in fact deposit tokens or a CBDC at all, because they have a very limited life and a limited purpose. The system uses them to reflect the money as it, sort of moves up to the edge of the division between the paying bank and the next bank in the chain, but no token ever actually moves from one holder to another. They all stay within the partition of the bank that issued the token. And then in the proof of concept, we assume they disappeared or were burned, but that wouldn't necessarily be the case. They would just go back. They could just go back into a treasury, to be used in the next transaction. We started out with the design questions around this system. Actually, the very first question that we started looking at was, what is the legal nature of those tokens, and what is how should they be characterized? You may be aware that tokens in the United States have a somewhat fraught situation at the moment. It would not be beneficial to a system if you had to deal with these being tokens that could be characterized as securities, commodities, or something else that could subject a system using the tokens to a whole level of regulatory constraint that actually might make it very difficult to create a functioning payment system. But fortunately, there was no need to worry about that. These tokens are not being used in any way that implicates any of those regulatory frameworks. So one of the very first decisions we made was between sort of, just express it as two extreme models. In one model, you have a system where the token itself embodies a deposit. The transfer of the token or the ownership of the token is enough to evidence ownership of an underlying deposit. So that would be like an old cashier's check or a banknote. That is one approach you could take to these kinds of a system. The other end of the extreme could be a system where the token exists and is used to carry out the mechanics of updating the ledger, but has no independent significance. And RLN is closer to that second model. That was driven largely, of course, by the way the system was going to work, and the technology and the goals of carrying out the payment were obviously the driving factor, and the legal analysis has to accommodate that. But I think it was also helpful to the legal analysis because it allowed us to rely for the next big issue on Article 4A of the Uniform Commercial Code. So the second big issue that we were dealing with was settlement finality. Could we get to the point where we could be confident that payments made through this system would have at least the same degree of finality than payments made through traditional payment systems today? Of course, we did come to that conclusion. And one of the important pieces of that conclusion had to do with making sure that we could control for finality, at least insofar as US law is concerned, at all steps along the way, including those steps that occur out with banks located outside the United States. That choice of law issue is a challenging question in any context, but at least if you're subject to Article 4A of the UCC, you can rely on the choice of New York law or whatever state law ends up governing the system to govern the entire payment chain from beginning to end, which is important when you want to know that everybody is going to achieve finality at exactly the same moment. So obviously settlement finality was another major point. And I guess the third major point, there were other things that we had to look at, but the third major point would have been the regulatory status of the parties involved in operating the system. There's obviously the participants in the system who would not want to be subject to a new regulatory framework simply by making a payment, any more than you would be today by virtue of making a payment through Fedwire or CHIPS. You already have to be regulated, but you don't have a new regulatory requirement as a result of that. And then there's the system operator, the entity that handles the operation of the ledger on which all these transactions are taking place. That entity, we think, would constitute a financial market infrastructure or a financial market utility, as we call them in the US. But unlike other jurisdictions, the mere fact that you are a financial market utility does not mean you are subject to an enhanced regulatory framework. We have something of a backward system in the sense that we have a very good and very functional regulatory framework for systemically important financial market infrastructures. In the case of payment systems, that's operated by the Federal Reserve. But that only applies if you have been designated as a systemically important financial market infrastructure. And of course, you have to become significant to then be designated and then be subject to that framework. The statute actually has some flexibility, but it's never been exercised in that way. So there is clearly a payments framework for payments generally in the United States, but unlike, for example, the European framework, it doesn't provide special protection for settlement finality. It doesn't provide for enhanced supervision unless and until you are designated. And even if you are designated, you don't get special protections for your finality of payments. So there were other issues we looked at as well, but I would say those were the top three on which we spent most of our time. So.
Thank you, Rebecca. JG.
Okay, thank you very much for inviting me here. It's a long time since I visited Basel. For Korea, I think I need to go back a little bit to give you a little bit broader picture about what's going on in Korea. In addition to the CBDC project, what the Korean government is doing is to actually enact some law that will cover a security token. So we have both a CBDC project where central bank as well as the commercial banks are involved, and also the non-central bank and non-financial institutions, non-banks, involved in creation of a security token of underlying assets consisting of real assets, mostly real estate projects or some artworks, those kinds of assets that are not easily saleable or marketable to the public. The reason why I'm describing these two different projects is because Korea has a very unique legal environment. Unlike in the US where you have a common law system, Korea is based on the court system, and also it's a positive legal system where the financial institutions and non-financial institutions, they may be able to act only pursuant to the laws that are specifically provided. And therefore, the question about all these issues revolve around whether the financial institutions and central bank, the Bank of Korea, can engage in certain type of projects or services that are envisioned by these projects. So for the central bank CBDC project, which consists of issuing of e-money tokens and also tokenized deposits, and also connected to the outside the CBDC system, where there is going to be another set of tokens that are tied to, for example, carbon credit exchanges. So those are three different types of tokens that are planned under the CBDC project. And for the most immediate issue is whether under the existing laws, these types of products tokens can be issued without amending any laws under the existing system. And for CBDCs, obviously, Bank of Korea has, under the Bank of Korea law, to issue the legal tender. The CBDC, the only difference of CBDC from the legal tender cash is just this digital form, and that doesn't require any amendment to the law. For the tokenized deposit also, the deposit can be issued by these commercial banks. It's in a different form, but that doesn't change the nature of the tokens as deposits, and therefore we did not think that the tokenized deposit by commercial banks would require changing any laws. For e-monies as well, there are certain specific laws that govern electronic financial transactions, and there are a lot of conditions relating to that, and therefore e-money tokens that are going to be issued by the financial institutions would need to be carefully reviewed by that. Currently, the Bank of Korea is focusing on the tokenized deposit by the commercial banks with some voucher functions. You know that the government is issuing some voucher to the residents, particularly during the COVID, and it cost a lot of money. And therefore, there is a programmability that is embedded into that, the token, and whether that's permissible and how that has a legal implication. So that was the first general point, whether there are any legal impediments under the existing law that these products can be issued. Now, for the tokenized deposit, there is one particular issue that is you probably know that Korea is very liquid market for general cryptocurrencies like Bitcoin and other crypto assets. And Korea is the probably most liquid market in the crypto assets outside the US, probably. And therefore, there is a lot of concern about protection of consumers. And there has been a new law to protect the consumers of the crypto assets. And the definition in that law is very broad to cover a lot of digital assets. And the question is whether the tokenized deposit issued by the commercial banks would fall under the definition of the virtual assets in that law. And because in Korea, the financial regulation is regulated by the Financial Services Commission, and the issuance of the monetary policy is handled by the Bank of Korea. There is a segregation of the responsibilities, and the virtual asset is actually governed by the Financial Services Commission. And therefore, there has to be some consultation between the two organizations as to whether this tokenized deposit will be exempt from the application of the virtual asset under this new law. And the solution to that is, without changing the law, the regulators and the central bank have agreed that they will process this through so-called regulatory sandbox, so that there doesn't need to be any actual changes into the law, but will give exemption from the application of law by applying the regulatory sandbox. So that's one area of the questions that we faced. The other one is that the privacy issue. Because this privacy law in Korea is very restrictive, and many of the transactions, if there is a identifiable information, for personally identifiable information, then that must be very carefully regulated. And therefore, if this unified ledger or central bank project, if there is a information sharing among different parties, under Korean privacy law, the sharing of information is, unless consented by the relevant individual, cannot be shared. And therefore, that's one issue that, that has to be continuously discussed. And as the unified ledger becomes more developed, I'm sure that there will be some further agreement about cryptographic protection, etc. But so long as the so long as personal information can be identified through various sharing of information, then that's the big concern for the system. And finally, I think the issue of the interrelationship between the regulatory agencies and a central bank, how that responsibilities can be shared or allocated on the Korean system is very challenging. Because as I said earlier, the financial regulation is governed by the financial regulators, and the central bank is responsible for monetary policy. And this unified ledger is actually consisting of various issues combining these two organizations, and therefore the relative allocation of responsibilities between these two regulators and the central bank would be very important. And that has not been yet resolved, but for the tokenized deposit, at least this regulatory sandbox solution is one compromise that they came up with.
Thank you very much, JG. Rebecca, in your top three legal issues, one of them was settlement finality, settlement and payment finality. And I guess it's fair to say that the rules on these issues in most jurisdictions were developed in a world where you could have a payments chain that would take days to complete.
Yep.
And I'd like to ask you and JG, how would the unified ledger innovations, like the ability to link payments through composability and programmability, or could it, or would it need to change the position with respect to settlement and payment finality? Would changes to the legal framework in this area be required, and what challenges would arise? And maybe, if you don't mind, I'll start with JG and then turn to you, Rebecca.
Okay. Right now, under the existing system, the there is a Korean law provision in the bankruptcy law that will make sure that the final settlement finality is guaranteed by the financial institutions. Now, we all know that the finality is an important issue because if once the payment instruction is given, some financial institutions goes bankrupt, and then this whole payment, because of the interconnectedness, if the payment is disrupted, then there is a large problem, and therefore we have a law that was adopted in 2005 that ensure that the finality of payment and settlement is guaranteed under the bankruptcy law. Now that is because there is the current system is a so-called deferred net payment system, where the banks are settling the net amount after the close of the day, even if the transactions happen during the day. So there is a delay of payment, and therefore there is a settlement risk, finality risk. So that is covered by this new law. Now, my view is that if we go on this unified ledger blockchain system, where everything is paid instantaneously and simultaneously, then I'm not sure that there is a real concern for finality because of this deferred net payment system. Because we are netting out, we are paying out on a basically gross payment system, an instantaneous system, so that maybe, Rebecca, you may have a different view, but in our view, this finality issue is not that apparent. One thing, however, I believe is more significant is if we use a smart contract, that might be a little bit different, because smart contract is a contract where you have automatic execution or implementation of the contract if certain conditions are satisfied. Now the question is whether your individual's payment instruction, which is based on certain satisfaction of certain conditions, is considered payment instruction now, or is it a payment instruction at the time of the satisfaction of the conditions? And depending upon how, I presume it is the latter, but depending on when exactly payment instruction is considered to have been made, I think the finality issue may be real issue, in my view. And therefore, I guess one thought is that maybe for the voucher system or some sort of government subsidy system where smart contract is used, there may be some mechanism to limit how often or what is the, how many times or time limit of the uses of smart contracts or conditions in order to prevent abuse of the system by commercial banks under this finality protection under the bankruptcy code. That's my thought.
Yeah, it sounds like we do have a lot in common actually across our two systems. So we do have a finality statute in the US, we call it FDICA, it's an abbreviation, but it provides for the enforcement of the rules of a clearing system, notwithstanding the failure of one of its members, and notwithstanding any other state or federal law. That statute was adopted in the early 90s and at a time when our settlement system, CHIPS at that time, also was an end-of-day net settlement. And so although it isn't preclusive of other systems, it's written specifically to protect net settlement systems. The definition of the systems that are protected by it has a reference to netting that may or may not, we think it does not limit coverage of the statute to systems that involve netting, but that question hasn't really been definitively answered. As a result, there's some question as to whether you have the protection of FDICA for any system that does not involve netting. Now, in most cases, with respect to if settlement is final before the point of that bankruptcy begins, I agree it should not be an issue, except we also have the distinction in the US of having something like 130 different insolvency statutes that theoretically could be relevant. We have insurance companies are liquidated or resolved under state law, so there's the 50 states for insurance companies. Banks are principally resolved under the Federal Deposit Insurance Act, but the organizing statute for a bank also affects its resolution. So there's the National Bank Act, and then there's the 50 state statutes as well. So even for CLS, we give the settlement finality opinion for CLS. Our opinion is something like 5 times as long as everybody else's because we have to go through all of the relevant regimes, and there's actually 2 other counsel that give opinions for Illinois and Massachusetts. So that'll give you an idea that it's a little different for us. So one of those regimes in particular, the National Bank Act, actually allows for the reversal of transactions that are final if they take place after, well, in contemplation of insolvency, and that can actually occur before the bank itself knows that it's failing. So now, there's exceptions to that, and it should not ultimately be a problem whether FDICA applies or not, but it makes it more complicated. And so if I had my druthers, I would have a new statute adopted that provided for finality of settlement systems regardless of whether it's a netting system or not, and regardless of whether the system's been designated. We don't think that's going to happen in the US anytime soon. And so, again, one of the reasons it's so helpful to have Article 4A apply is precisely to ensure that you have final settlement immediately. I am concerned about the smart contract issue you raise as well. I think that we would not view the transaction as final until the ownership of the funds has changed hands. And so if you've entered into a smart contract but it hasn't yet settled, you're going to have a question there as well. Another issue that may become relevant is that these systems are all going to have to be interoperable with all of the other settlement systems. And so in the US, we have different statutes determining when settlement is final for securities as opposed to cash. So we'll have to make sure that we can synchronize those 2 things when these systems become DVP. I think that's going to be possible, but we have to work that through. There's also the issue that if we're dealing with PVP and currencies on a system that operates actually using tokens as opposed to the way we've used tokens, but like ownership of the deposit is moved by moving the token, we may have to be concerned about whether you have finality of a transfer of a token. At this point in the US, we have a statute that solves, well, there's two problems really with tokens in the US. One of them is what law governs whether an asset like a deposit or an obligation like a deposit is actually successfully tethered to a token. The other is whether you can successfully show that you have a final transfer of a token from one person to another. We have a statute that's been drafted by the Uniform Law Commission, which is, generates the Uniform Commercial Code in the US, and they've proposed amendments to the Uniform Commercial Code that deal with that second question of when a token ownership has changed hands with finality. But it expressly carves out deposits from its coverage as well as securities for a couple of reasons. One, deposits are all already electronic, and there was a conclusion that you didn't really need new law to deal with what is already an electronic product. I think we will see whether that remains true. It was also out of deference to the regulators who are still working through their views as to whether you can, in fact, tokenize deposits and still be a deposit. I think if you look at the definition of deposits in most statutes, it doesn't refer to the particular computer system used to record the ownership of the deposit. But there is some anxiety around whether record-keeping requirements can be satisfied and whether the FDIC can get what it needs to get if it has to liquidate a bank that's involved in a system like this. And so there was a sense that it was just premature to deal with that in this statute. On the security side, again, there is a mechanism in place to deal with the electronic transfer of securities, but it doesn't contemplate blockchain specifically. Whether that's a problem, I think, is not yet known. I think that you ought to be able to fit into the existing statute, but there's actually an American Bar Association committee that's now digging into this. So there's a lot of efforts looking to see whether we'll be able to synchronize both across systems in the United States and between the United States and other systems.
Maybe turning to another question, which actually my colleague Morten Beck alluded to in his description of the plans for Project Agora, which is non-resident access to these different systems. As I understand it, both the RLN and the Korea project limit participation to domestic banks. And I'd like to ask you sort of what extra legal challenges would arise with the inclusion of non-resident banks in these systems.
So we did, RLN,
Go ahead.
So RLN limits settlement banks,
Yes.
the banks that can make central bank settlement, to domestic banks. And that's driven by the restrictions on who is able to have a master account at the Federal Reserve. So I don't think that's something RLN can change, but that doesn't mean other banks can't participate and settle through correspondence, and the system contemplates that. What there is, though, is a restriction on the nature of the entities that can participate. So it's essentially limited to entities that are financial institutions for purposes of fiducia, that statute that I mentioned. The reason for that is this finality question. That means that it is limited to entities that are banks, broker-dealers, oh goodness, there's a list, but those are the principal participants. Commodity brokers, I think, are also included. It would not include e-money providers because we don't have e-money providers as a category in the United States. Well, we may, but we don't have a regulatory framework for them. And so they're not contemplated by fiducia. And it's another one of those things that one might fix if you were starting with a free hand.
Yeah, for this project, Bank of Korea obviously is limiting to the Korean commercial banks or foreign banks that have operations in Korea. If they were to allow banks outside Korea, which do not have operations in Korea, they need to change the internal regulations to allow that. And they need to have some sort of operating account, the current account with the Bank of Korea. And for that purpose, they need to change the internal regulations. And the reason for that is because they like to be able to monitor the actions of the banks that are outside Korea. And so that's one issue. And I think broadly, this foreign exchange I mean, opening up the system to non-resident is a big issue in Korea because Korean currency is a non-reserve currency. It's not internationalized, and therefore all the settlement has to go through banking institutions through to Bank of Korea, and the Korean regulations actually protect or guarantee convertibility only for the Korean won currency that is residing in Korea. Any Korean won currency outside Korea is not protected or guaranteed for conversion by the Korean Central Bank. And therefore, there should be some mechanism, unless the Korean currency is really internationalized, which is not. And therefore, this non-residence issue, and particularly for the CBDC project, will have to resolve those convertibility issue and the FX regulatory concerns going forward. And I think the project Agora and some other projects that are mentioned during this summit would be a very helpful way toward achieve that objective.
Thank you. JG, maybe a follow-up in the few minutes we have left, but what about involving non-banks?
Non-banks?
Yes.
Non-banks can be involved. Actually, one of the project element which relates to e-money token to be issued by financial institutions envision non-banks to come into play later. For now, they are limiting it to central bank, the commercial banks, because of obviously various logistical concerns, and there are legal uncertainties about opening up these e-money tokens to non-bank financial institutions, and therefore, initially, the Bank of Korea is focusing on test piloting program only for the banks, but it will be extended further. But for that purpose, there are a lot of additional legal issues that have to be reviewed and consulted.
Thank you. We just have 2 minutes left, and maybe I can finish with a question for you, Rebecca. The legal report for the RLN POC scoped out consideration of the organizational structure and responsibilities of the RLN FMI. Could you maybe briefly describe, some of the pros and cons of different types of structures that were considered?
So we thought about a number of different types of entities. I think some of the considerations are peculiar to the United States and go back to this question of whether there's a regulatory framework that's suitable for an FMI operating a system of this kind. I think we have a framework in the United States, the Bank Service Company Act, that gives the regulators the authority to supervise the provision of services by companies to regulated financial institutions. And that framework is fairly extensive and gives the regulators a significant amount of authority, but it does not give them the authority to regulate the capital levels of the entity providing the service or to provide consolidated supervision of the whole entity. And so I think there's been a thought that it might be better for a system that is likely to become systemically important, that it start from the beginning as an entity subject to overall prudential supervision and regulation. And that was why I think we talked in our report a little bit about the possibility of forming it as a banking type of entity that would operate the ledger. That said, this entity would not be holding any funds. All the funds will be held by the members, not by the operator, and it will be engaged principally in technology functions, unlike, say, a CLS. And so whether that's the best approach or not is something that would have to be worked out. I do think that the expectation is that being regulated as a systemically important financial market institution would probably make sense, and the question will be whether that's possible from the outset.
But you would have to have an entity that would be regulated.
Well, we don't have a system that says you have to be a regulated entity to operate a payment system. There are regulatory requirements that apply to different activities. We have state regulatory requirements for payment services providers under our Money Services Businesses Act, they're not really suited to this kind of wholesale service and international service. They're really focused more on protecting consumers who are doing cross-border payments and remittances and other payments, although they apply to other kinds of payment services as well, crypto providers, PayPal, all the people involved in handling money who aren't essentially banks or otherwise exempt, speaking loosely. But they don't seem like the right framework for this. And I think, again, just given the significance, there was a sense that the participants would prefer that it be subject to regulation of this kind.
Thank you. I'm afraid we've run out of time, but I've been advised that there will be time for questions, but over a glass of champagne in the apero. So please join me in thanking our panelists for what was a fascinating discussion. Thank you.
This discussion concludes the first part of the BIS Innovation Summit. Thank you for your active participation today. Tomorrow morning, we will reconvene at 8:15 in the morning. With this, let me invite you to an apero that you will find right here outside of the auditorium. Thank you, everyone. Have a wonderful evening, and see you tomorrow.